morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Diane King-Hall in today for Brad Smith. Here are three things you need to know this morning. First, debt ceiling talks, well, they aren't going so well. After leaving the Capitol yesterday, House Speaker Kevin McCarthy said the parties had yet to reach a deal avoiding an unprecedented debt default. Key Republican negotiator Garrett Graves added to that downbeat tone. He said both sides were at a standoff. The Senate and House still need time to review any deal if and when it happens. Then they need to vote on the legislation. That means making the so-called X date of June 1st is looking less and less likely. And Florida Governor Ron DeSantis is set to announce his 2024 presidential bid this evening on Twitter. CEO Elon Musk will host a Twitter Spaces interview with DeSantis, who's seen as Donald Trump's main rival for the Republican nomination. The event brings back to the fore the idea of Twitter maybe becoming a media platform. That possibility was ignited earlier this month when former Fox News host Tucker Carlson said he was launching a show on the site. We're going to speak with NPR's David Gura on the future for the platform after a public spat ensued when NPR was designated state-affiliated media. And a silver lining amid the retail doom and gloom from Kohl's. While Places reporting a surprise quarterly profit amid a push to reinvent itself and lure back customers hit by rising inflation. Net income coming in at $14 million for the first quarter. That's 13 cents a share. The department store CEO Tom Kingsbury, who's only been on the job for about 3 months, he said Kohl's got hold of excess inventory and brought in customers thanks in part to the lure of Sephora. Last year, it expanded the beauty shops to all of its stores in a bid to attract a younger customer base.
All right, let's get right into this debt ceiling deal. It doesn't seem any closer. House Speaker Kevin McCarthy said the parties had yet to reach a deal avoiding an unprecedented debt default. Key Republican negotiator Garrett Graves added to the downbeat tone, saying both sides were at a standoff. Joining us now, Tony Crescenzi, PIMCO market strategist and portfolio manager, and David Gura, NPR correspondent on the business desk. All right, let's get right into this, Tony, with the latest. Good morning. We've been here before. What about this time is different to you?
Not much. It's a 70. And I'd say, as an older person working in the 1980s, since the 1980s, we've seen this a lot of times. As you may understand, it's been 78 times that the debt ceiling had to be increased. It's just a lot of drama. I wrote a book about this sort of thing a decade ago, not to try to sell books, but the idea of debt, reaching the limits of debt use. It's called a Keynesian endpoint. Remember, John Maynard Keynes, a famous economist in the Great Depression, said, if you have a problem, spend money. And that's what politicians, you could say, have been doing for decades. But we're reaching the limits to an extent, given that we have high inflation from all the spending. Think of the UK, the United Kingdom. In the fall, Prime Minister Truss ousted when she tried to increase indebtedness. So perhaps we're reaching the limits of debt use, some practical limits. We'll always have more debt, but there's a practical limit if it has bad effects. And I think that's what markets are thinking about to some extent. And you'll see a pushback by markets, more importantly, in the future, about the increase in indebtedness, not simply politicians.
I want to get to David in a minute, but I need to follow up on this point. How do we know when we're getting to that point, right? Because as you say, like, the U.S. has piled on debt and debt and debt and debt, and it hasn't paid really any price for that for a long time.
People always say, well, when will it hit the fan, so to speak? It isn't an event necessarily. It's a process, although in the UK, it was an event. A decade ago in Greece, it was an event. There was a Keynesian endpoint. It could no longer borrow from the financial markets. You could imagine in a scenario where the debt ceiling is increased in the next week, which we expect at PIMCO, that if politicians in the next couple of years decide to raise indebtedness, increase spending again and borrowing, the bond market would react pretty negatively with much higher interest rates. And so I think we're there, but you won't know it till the bond vigilantes, as they're called, come out. And I think that's what you'd see.
David, let's get you into this conversation about the debt ceiling. We've been here before. You've covered this before as well. What stands out to you this time about this debt ceiling debate?
A couple of things. I think first is timing, which you mentioned at the top, that this calendar is getting increasingly tight. And I think that lawmakers in the White House are both aware of the fact that this is going to get increasingly difficult as these days tick by and we get closer to that X date as defined by the Treasury Secretary. But the other thing just has to do with the speaker's majority. I go back to the last time we kind of went through this in a big way when John Boehner was the speaker, and he had this massive Tea Party Republicans behind him, I think 60 of them in total, who really preached austerity. He was kind of riding that wave and was able to sort of make demands as a result of that. He didn't fear that he was going to lose his power as a result of making these demands. I can only imagine that the negotiations, especially between House Speaker Kevin McCarthy and the president, are quite strange in a way, because I think the House Speaker has to be aware of how narrow his majority is every day that he's in the job, and it certainly must disadvantage him in some way as he's making these deals or trying to broker these deals, because he has to think of sort of what the repercussions might be. And I think a lot of strategists I've spoken with have said they very well may agree to a deal in principle, but it's still going to be largely an unknown, at least in part, if he's going to be able to get the support of his caucus to back whatever deal they come up with.
Yeah, I mean, it's so interesting, the two of you, because we're having this discussion about like sort of the nitty gritty sausage making, et cetera, of today. And then there's the bigger idea that Tony is talking about. Dave, I have to admit, I heard you in your other gig this morning on NPR talking about this very issue. And as you pointed out, one of the things that has prevented more severe fallout from these 78 times, and yet once again today in the bond market, is that the so-called TINA acronym. There is no alternative. There aren't a lot of other good places for bond investors to put their money. So I would ask you, first of all, what you're hearing on that, and then I want to get Tony's take on it as well.
Yeah, a few people brought this up to me. I was talking to folks in the context of sort of what happens to ratings, and the piece that I did this morning kind of centered on that. Of course, S&P Global did make that downgrade back in 2011. I'd love to hear what Tony has to say about the reaction to that. As I recall, I think it was actually quite good for Treasuries, to the surprise of many as a result of that. But I think that illustrates the point that you're making, Julie, which is, if there's a downgrade or a default, we're in this kind of strange circumstance where you have something that's been seen historically for such a long time as a really safe asset, a really safe investment, and that's kind of thrown out of whack. And getting back to what Tony said a moment ago, I'm really kind of still surprised that we haven't seen more of a market reaction yet to all of this. I'm kind of curious when that comes. And going back to the calendar, yes, we're 8 days out from that X date, but there is still largely a kind of complacency to markets here, which I think illustrates what we've been talking about, that we're kind of inured to this for better or worse. We've been here more than 70 times. As Tony said, this is kind of like a recurring thing in the way that Washington does business for better or worse. And I was actually talking to Tony's colleague, Libby Cantrell, who made the point that, as far back as when House Speaker Kevin McCarthy was just a congressman trying to secure that job, you saw kind of interest in Wall Street and gaming out what was going to happen with the debt ceiling. And she made a point, and I think it's a good one, that it kind of kickstarted Wall Street thinking about this earlier on. So I think that it very well may be less of a surprise to investors this time around than it was in the past, just because they've had to kind of think about the realities of this for longer than they have in the past.
Tony?
Yeah, David, we would agree. I mean, the market reaction has been small. The equity market hasn't faltered much. It looks like typical volatility. Even in the T-bill market, where you could purchase T-bills that mature around the so-called X date, they're performing reasonably well, and you're compensated for the expected delay in payments if there is one. And so it looks like markets are taking it in stride, and as they probably should by our assessment, because we think that the deal will get done before the end of the weekend, or certainly before the X date.
And you brought up an earlier point, Tony, about spending and how it was the idea to paraphrase, throw money at a problem. And that's been one of the sticking points for House Speaker Kevin McCarthy, who wants to cut spending. And one of the sticking points in there has been the work requirements piece. And to your point, we've been here before with regard to that, because one of the work requirements piece would affect TANF and SNAP. Right? That's the what some call the entitlement programs. That they take a lot of money, and one of the things he wanted to do was, if they're able-bodied people without dependents, to focus on cutting there. Now Biden differs in that. So this time there is, to your point, yes, we've been here before in terms of the debt ceiling. They always find a way to get it done, but it doesn't seem to be a middle ground on this issue, and also very different than what you saw back in the 90s with the Work Opportunity Act, which got loosely called the Welfare Reform Act. So what would you say, I mean, if they didn't reach a deal, what happens?
We don't want to go there, I would say.
Right.
I mean, as you said, we don't want to see how the sausage is made. But you mentioned this work requirement issue, and there are other spending issues that people talk about, but the one big one, of course, as you referenced it, is mandatory spending. It's the vast majority of spending, and it's the third rail of politics. So I was thinking about that down in the subway before I arrived here at 770 Broadway, and it's an area that politicians are loath to go. We know that the older cohort of the population votes at double the rate of the youngest cohort, which is odd because the future is determined by who we put in office. But the older cohort is very large. It's populated by baby boomers, for example, people born between 1946 and 64. They're still in charge. You can call it a gerontocracy. The idea that older people are in charge of policy. Now, there's that issue, the mandatory spending that won't be changed until the last boomer turns 65 in 2029 at least. Final quick word is interest payments on the debt. We're going to have a read my lips moment, and I'm referring to George H.W. Walker Bush, 1990, said, read my lips, no new taxes. But he went back on that pledge because the interest on the debt reached an all-time high of 3.2% of GDP. It's currently 1.7 to 1.8%. It's going to reach that 3.2% in about 5 years. It's going to cause politicians to have to start to think about the debt in the way that Bill Clinton did and solve the problem, and we reached a budget surplus. So we've got a lot of issues ahead in the years ahead because we've got a lot of problems ahead in terms of new spending on mandatory spending and interest.
Well, and the other funny thing about this whole situation is our Rick Newman, who covers politics for us, Dave, he pointed out yesterday that the last time we had a more of a debt ceiling fight, there were spending cuts that then the next administration just came in and reversed. So like all of this fighting is kind of for nothing unless it tackles some of the more fundamental issues that Tony's talking about. All of this stuff is like just sort of, I mean, for lack of a better word, piddling stuff on the margin that is probably not going to be lasting anyway, because another Congress or another administration will come in and just switch it around anyway.
Yeah, they can roll it back. And I think we've already seen that kind of broadly with what the White House has said. I mean, they came into this saying that they weren't going to negotiate, and lo and behold, they are negotiating. They're trying to craft some sort of deal as a result of this. But I think Tony's getting to something really important, and that is there are these really big issues that Congress and the White House policymakers largely have to sort out. And I think what's difficult is that we've kind of forced all of that into this crucible. And he talks about a kind of Keynesian event. We have this event now that's definitely man-made, definitely as a result of the way that our government is structured. But so much stuff is crammed into it. And I think the reason that is that Washington seems unable to have the kind of bigger and important conversations that Tony is outlining. Yes, we have to talk about sort of the trajectory of debt and deficits and entitlements, but we have all seen the polarization and the lack of progress that takes place in Washington today. It just seems to be the case that you have to have this forcing mechanism. You have to have some fire burning beneath lawmakers and policymakers to get anything done. I think we can all agree that that's kind of a shame. People are sent to Washington to tackle these issues and to debate these issues and to make progress. That has been a rarer and rarer thing here in recent years.
Yeah, one of the things perhaps we're not polarized on, I guess, is that. Tony Crescenzi, PIMCO market strategist and portfolio manager, is going to stay with us. So is Dave Gura, because we have to talk about this. Speaking of politics, Florida Governor Ron DeSantis, he's set to announce his 2024 presidential bid this evening. He's going to do it on Twitter. CEO Elon Musk is going to host the Twitter Spaces interview with DeSantis, who is seen as Donald Trump's main rival for the Republican nomination. That event brings back to the fore the idea of Twitter becoming a media platform. And it's a good time to have Dave Gura with us because NPR had its own back and forth with Twitter earlier this year. David, this had to do with labeling NPR a state-sponsored media organization. And it's interesting now because I guess effectively Twitter might see itself also as a competitor to some of the traditional media organizations. This really seems like a win for DeSantis to roll out his campaign in this way. I don't know. How are you thinking about this whole situation?
Yeah, I think it's getting a lot of attention. It's a novel way of doing it. I'm sure he'll do kind of an in-person event after this, but it's certainly attracted attention just because it is novel. It is new doing it in this forum. And with Elon Musk, who's fashioned himself an inventor, an executive, sort of a media tycoon, and now, I guess, interlocutor and kingmaker of politicians as well. So we'll see how the interview goes. And you bring up sort of what happened with NPR, and sort of speaking for myself as I watched all of this unfold, he labeled NPR as state-funded media, changed that to state-aligned media. And I think that what the organization for which I work found out is that Musk has a kind of a limited sense of what he intends to do with the platform. And so NPR was kind of seeking answers on what how he was making these characterizations, what they meant, obviously pushing back on the ones that were wrong. And there was a plasticity of the way that he was running the company that I think was troubling to NPR and other media organizations as well. I think that's emblematic of sort of where we are with this platform. He is very present, as we all know, weighing in on politics more than he said he would. And he continues to say that he wants it to be this kind of town hall forum where people with different opinions can make announcements and debate one another. A lot of people have pushed back on sort of how freely that's happening and who's able to do that, and certainly sort of what's allowed into the public square where he is the de facto mayor. I'll say, just again, going back to sort of our experience with how this worked out, there's no way of accessing policymakers at Twitter now. It really is kind of a one-man shop. And so you just showed a tweet there by my colleague, Bobby Allen, who's a tech reporter for us here at NPR. He's had this kind of on again, off again email correspondence with Elon Musk, where lo and behold, he replied to an email from Bobby about the first way that he labeled NPR. They went back and forth for a time. Of course, the labeling changed. Then there was silence, and he came back once again. So it's a weird thing to have that level of access and to see an executive who's involved so granularly in the operations of a company. I'm going on and on here, but I think that it just kind of represents the fact that he's still kind of finding his way around what he wants to do with it, and certainly getting attention and more people to use the platform seems like one that's quite logical if he's hoping to pay the debt that he owes for the company.
To your point, David, we saw Tucker Carlson recently do, kind of a "I'm back" on Twitter, and now with DeSantis coming there for an announcement later today, which is expected to be a announcement for a presidential bid. What does that signal in terms of the political leanings of Musk and Twitter?
Just as I observe it, I think that he is interested in kind of stirring up controversy. He seems libertarian. He has a lot of friends who are venture capitalists in the Bay Area who are libertarian. I see like that kind of voice is getting a lot more presence on the platform. But I think candidly, he likes the attention, and he likes the fact that he's having a role here in shaping obviously what's going to be a critical election here in the next year. We saw him retweet something from Senator Tim Scott earlier this week announcing his decision to run for president. He said in the past that he's admiring of Ron DeSantis, and maybe this is that. I mean, he's a confusing person to pin down when it comes to politics, of course, because he said he voted for President Biden in the last election. Now we're seeing him kind of making overtures to these Republican candidates. So I think that as there's squishiness about sort of the direction of the platform itself, there is this also squishiness just about his sort of political leanings and whom he supports, and sort of how he intends to play this as the election takes shape and the campaign begins in earnest.
Right. And to be clear, we know he's hosting this conversation today, but we don't know if he's actually endorsing DeSantis. It doesn't seem like that is automatically happening. Tony, I want to bring you back into this and just ask you more broadly about, I know it's early to think about the presidential race as it relates to markets. We got to get through the debt ceiling. We got to get through a lot of other stuff first. But I am curious if you've started to think about that at all, or at least as how the sort of political climate in the U.S. relates back to markets.
Yes, and first on the calendar, though, in 2024 is a Taiwan election, and it could shape how events go geopolitically. But probably more importantly in the next cycle will be how President reimagines the global order, because it's changing, it's being reshaped, it's being reset. For example, companies are deciding to look at matters through a national security lens, to think about their supply chains. Should they source items, goods from China, et cetera, et cetera. So there's a rewiring underway. Now, so the next administration will have to think about how can it benefit the United States? Could we have what Dwight D. Eisenhower did in the 1950s and 60s when he established the Eisenhower Interstate and Defense Highway System, it was called. They used the word defense to justify the spending on an investment of 50,000 miles of roadway we all still use and we have seen benefit from for decades. So will there be something like that ahead? So it's going to be a critical moment in that sense, because we are reimagining, reshaping, resetting the global order, and you want to see it done in an intelligent way to bring about faster growth for Americans.
Just quickly, we've seen obviously some reshoring efforts already on the part of this administration. Is that good for the U.S. economy and for the markets? And do you think, even if we get a change in administration, that they might continue that kind of push?
It can be good, all of that investment, if it's done wisely. We know that growth is determined by three sources. It's people, our skills, our education, et cetera. Secondly, the things we put in place. I mentioned the roadways. And third, what they call total factor productivity, TFP. How we use people's skills, how we use the things in place to be productive. So if we use it wisely, and I think we're all focused, but we all need to focus together, but there isn't a lot of togetherness these days. So that's where I get a little worried.
There isn't a lot of togetherness. David Gura, great to get some time with you here this morning. NPR correspondent on the business desk. Hope to see you again soon.
Yes.
Togetherness.
Absolutely.
Indeed.
Thank you both. Appreciate it.
Thanks.
Indeed.
And as the AI craze escalates across tech and beyond, a move yesterday may have highlighted a limit to the takeover and this sort of obsession that we have with all things AI. Shares of Zoom Communications fell by over 6% in yesterday's session, proving that the video platform's AI expansion wasn't enough to sway investors. That drop could be a signal that despite apparent AI hysteria, consumers need more to be convinced, and especially investors might need more to be convinced. Let's get back to Tony Crescenzi, PIMCO market strategist and portfolio manager. And this was something I wrote about in our morning brief today because it struck me that, we were doing all these counting of conference calls, right? And on Zoom's conference call, it was something like 80 times that the AI. Phrase AI was mentioned. And yet, investors still want to see a growth prognosis for a company. So how do you think people should be weighing all of this?
Well, for those who can think back this far to 1995, it was a so-called technology shock. So it reminds me of that. Lots of worry about what that new technology, such as the one we're being transmitted from right now. It was the advent of new technology that people thought would displace workers. But think last month, the U.S. jobs report.
It created jobs. It was better than expected.
Right, Diane. 3.4% jobless rate, the lowest since 1968.
Right.
So even amid tremendous change over 20 years, we still have a low jobless rate here in the United States and in Japan, for example. So yes, in certain industries there'll be this creative destruction, but we'll more broadly probably have
And it does seem like each time we're in a cycle like that, there's this kind of scary part of the cycle where, yes, it causes jitters and you worry about the displacement within or disruption within your industry. And to your point, like we were all like, what was it? We were heading into, was it Y2000? Was that what it was? Yes, Y2K, exactly. We thought all the computers were just going to shut down and everything. So that was the advent of a new age, the 90s. And, so we've experienced that transformation in AI, generative AI especially. But what does that, does it even matter to, financial markets in general? In the sense of let's say the bond market, does this generative AI matter in the bond market?
It's hard to imagine. We're using it at PIMCO and others are simply for research and to gain insights, perhaps to do some writing, to have help with our writing. So it could create efficiencies, ChatGPT, that sort of thing. For the markets, I think the more information that an investor has in his or her hands, the better to make informed decisions. And I think AI will help bring that about. So perhaps it'll create efficiencies. But what it won't do is change liquidity in financial markets, because ultimately you have to have an intermediary. It's called the principal agent model. And so it won't change that. It simply supply us with more information. To take it to the extreme in a different fashion, investors worry about the information flow they get from China on companies. There's not enough of it. So AI
or that it may be fuzzy.
Yeah, and it shows you that assets can become underpriced, and there's inefficiency in terms of raising capital because of that, because the price of capital then can be higher. So it could lower the cost of capital in the end, is what I'm trying to say, because investors can make informed decisions.
I want to broaden it out a little bit, because as we talk about these various parts of the market right now, I know that you are still bullish on the bond market sort of broadly, right? But drilling into that, I'm looking at some of the things that you favor: agency mortgage-backed securities, cash and short-term strategies, total return and income. And I'm just curious, as we sort of go through the rest of the year, given what we might see from the debt ceiling, from the Fed, et cetera, et cetera. So you don't think we're sort of at peak yields then, it sounds like, maybe?
Well, so the Memorial Day weekend is ahead, and one thing that a bond investor can get excited about, a nerdy thing, is 3 days of interest payments. And so these days they get excited looking at the interest payments hitting client accounts, my account, owning T-bills, whatever. And so yields might go up perhaps a little more, but we think they're likely peaking. So one quick view on this. The aggregation of bonds, treasuries, mortgages, corporates, according to the so-called Bloomberg aggregate, is about 4 5/8%. For credit securities, about 5 1/4%. With a little so-called alpha, this means that returns are likely to be 5-6% in high-quality assets, because starting yield is the major determinant of future returns. Now, importantly, that yield is up from 1% as a low. We think they're near the peak because of one simple factor. Last year, markets had a big miss on the forecast for the Fed and what it would do. They said 1% forecasters, it was 5. This year, markets are saying 5, It won't be 9. Maybe it'll be a little higher. Probably not. We think the Fed's done. But the forecast misses plunge, and yields peaked last October. And there's stability in the bond market and return to correlation, as they say. When stock market falls, bonds rise. So we're expecting more of that.
So it's still a safe haven because there are no other havens.
And it's Tara, there are reasonable alternatives these days.
Okay.
Well, but
Tina.
But I guess what you're saying too is that whereas yields may have peaked, they're not going to come down that much.
But the key is, though, and this is the history of it, is going back to 1978, 90% of the time, core bonds, meaning with an average maturity of, call it 6-7 years, high-quality bonds, have outperformed T-bills on a 3-year rolling return basis. So lately, of course, last year was a bad year for bonds and core assets. But just a few months before a recession, they tend to start outperforming, and 3 years later, you'll have this outperformance. And the average has been 3 percentage points. And so it looks like yields could decline. That's the thing you got to be thinking about. Get price gains that help you beat T-bills.
All right, we got to put a pin in our conversation. I love all the topics that we're going through here.
Thanks, Diane.
We appreciate you so much.
you.
Tony Crescenzi, PIMCO
Julie.
market strategist and portfolio manager. We appreciate you. All right, sticking with AI, Elon Musk is issuing a stark warning about the technology. Speaking at the Wall Street Journal CEO Summit, Tesla CEO said, quote, there is a risk that advanced AI either eliminates or constrains humanity's growth. Yahoo Finance's Pras Subramanian joins us now with the details. Pras?
Yeah, a little bit of a dire warning there. I mean, eliminate.
He's made them before.
Yeah,
Yes.
right. But eliminate or constrain humanity's growth, I think, is sort of stuck out in a lot of people's minds. But, he followed up on that later, talking about how he thought there was possibly an unbenign scenario with AI. Again, he said that there's a non-zero chance that it could go full Terminator on us, like the James Cameron film. So, he's talking about these things, but also said, hey, it's possible that it might think that humanity needs to be protected against itself, so it'll take control of all the systems, all technology, weapons, and things like that, right? So he says these things, very, very stark warning. But then he's still investing in AI, right? He's talking about how there needs to be a third horse in the race between Microsoft and OpenAI, Google Bard, and then someone else, and he thinks it should be XAI, his new startup.
Yeah.
Of course he does.
Right, and he said there's some news will be coming on that. He said he teased some news, said that possibility of them working with Twitter and Tesla, his other portfolio companies, in some fashion. And he also mentioned that Tesla is still working full steam in AI with FSD, going to be powered by end-to-end neural network AI. So he's still working in that world, and he's still talking about that. So it's kind of like saying one thing and saying another at the same time, but still the headlines are that constraining humanity's growth and things like that.
So the stuff that he's working on, right? I'm getting sort of like only I can fix it vibes, right?
Yes.
Is he saying that whatever AI projects he's working on would address these AI takeover domination concerns?
I think implicitly he's saying, I won't be the one that will make AI come after us if I,
Sure.
use that technology. But he did say that there should be an insight committee, not oversight, an insight committee that's formed of experts and government officials that meet from time to time to look at the progress of AI and then can give recommendations to people, to governments to possibly regulate. Not that he wants that group to regulate, but he wants them to give recommendations. So that's his sort of solution for how do we tamp down AI's possible overexpansion into our lives and possibly, changing our lives.
I wonder if he and Ron DeSantis will talk about AI tonight.
Well, I'm sure.
That would be quite interesting, actually.
Well,
that would be kind of, I don't know, that would be
but
interesting.
it does remind me of what the godfather of AI's comments were when he left Google and was commenting on, the potential dangers. But, the criticism then was, well, why didn't you comment before?
Yeah, well, he was getting a paycheck. Okay, thanks, Ross. Appreciate it. Coming up, coal's climbing higher today on a surprising profit. We're going to break down that and some other top movers and bring you the opening bell next. We just had the opening bell on Wall Street. Let's do a quick check of where we have opened up this morning, sponsored by Flex Shares. We've got a lower open. The Nasdaq leading the way down by about 0.7%. The S&P off 0.5%. The Dow off about 1/3%. The lack of progress on debt ceiling talks maybe is finally weighing on markets. We also had UK inflation that came in higher than estimated, and also some more consternation about China growth as we see the COVID virus actually ramp up once again there. So we're going to be watching all of these issues and how they affect markets. But let's talk about some movers, shall we? Can we call it a turnaround? Shares of Kohl's surging this morning after the company posted a surprise profit and reiterated its full-year outlook. Kohl's is disappointing investors in recent quarters, but the company is looking to reinvent itself and woo some middle-income consumers. Part of the way it's doing that, Diane, Sephora, right?
No.
That seems to
Yes.
be bringing
Because
some traffic in.
Yeah, we were having that chat about like who's shopping at Kohl's. No offense, Kohl's. And, you know, I always make the joke about Kohl's Cash because I know people who go there love their Kohl's Cash.
Oh, really? Okay.
Yes. But I think, you know, another thing that Kohl's did well is just putting certain brands in there that, you know, so if someone is in there, like the Amazon drop-offs, like if you're returning an Amazon, if you're already in Kohl's, you see something near the checkout, I suppose you pick it up. I know I've been there with my little son before, and he's like, oh, can I have this? And I forgot about that as I'm, you know, thinking about it. So putting those things like the Sephora in there, and look, you're seeing shares jumping 18% on this news. So very different than a lot of the other retailers we've seen, and in terms of the warnings that some retailers gave this earnings season, right?
Yeah, just a couple other things to note here. When we look at same-store sales, they were actually down more than estimated. They fell by 4.3%. However, gross margin was better than estimated, 39%. And that was above the average analyst estimate of about 37%. Like many of the other retailers that we have seen, they started to work down inventories, which is a positive thing, down 6% in the first quarter. So that's also something that helped matters here. So interesting here, Tom Kingsbury is the relatively new CEO. He took over in February, and so he does seem to be making progress. One note I want to mention when we're looking at this, what seems like an outsized reaction in the shares here. Well, first of all, the shares have done very poorly going into this. Secondly, the shares are heavily shorted. 19% is what I'm looking at here in Bloomberg data, is the percentage of the shares of the float, that is shorted. So that's a relatively high number, and that implies that at least some of the upside today could be short covering. So that may be
This is true, and I mean,
exaggerating the
obviously,
move.
yes, it may be exaggerating the move, but they certainly perform better when you compare it on a year-over-year basis. And I want to get to one other retailer that we've been looking at today, Abercrombie & Fitch. So shares of Abercrombie & Fitch also rallying. That stock up double digits this morning. Another retailer reporting a surprise profit, earning over $16 million. That's them swinging back into the black from a year ago. You're seeing that stock up 23%. The company also hiked its annual sales forecast. Total sales were up 3% in the quarter, and comp sales also rose 3%. So what it looks like is some of these like specialty retailers are just reaping the benefits of being a specialty retailer right now. Specialty, and also like ones that hone in on certain demographics, if you will.
It does seem that way here. I mean, the one spot that did not do as well here was Hollister. We have a lot of Abercrombie stands on the staff here, and what they have pointed out is that while Abercrombie, the namesake brand, has really updated its assortment, and stayed relevant, Hollister hasn't necessarily, and still sort of is very teen focused, and so maybe that's part of what it is. Our armchair retail analysts here who are also happen to be shoppers, so that's something. But you know, I think this really caught a lot of analysts by surprise and investors by surprise as they were looking at these numbers. Something else, again, I'm looking at the short interest here. In this case, it's not as high as Kohl's. It's about 13% of float. But again, here, you're probably getting some short covering that is helping to push those
And not
shares
these
higher.
kind of shorts.
Yeah, no, not the shorts, not the mom shorts or whatever it is that are popular right now.
You wouldn't find that at Abercrombie & Fitch.
They're kind of in
mom
now.
shorts?
The mom shorts are in now. Am I wrong?
I don't think they're.
I don't know.
Oh, they're in.
Yeah, they're in. I'm told. Mackenzie DeGroot, breaking news. The mom shorts are in, just like dad sneakers are in. Shares of Urban Outfitters. Let's talk about that too. They're also jumping after the company beat estimates on the top and bottom line, with sales at Free People and Anthropologie increasing by double digits. So this obviously continuing on the theme here of these sort of specialty retailers that performed better.
Yep.
It's also, by the way, continuing the theme of maybe a little short covering. 15% of these of the float of Urban Outfitters is also shorted. So similar, maybe a little bit of short covering here.
Yeah, indeed. All right. And a programming note on this, Brian Sozzi will be speaking to Abercrombie & Fitch CEO Fran Horowitz. That interview will air in our 3 to 5 show. You do not want to miss that. Meanwhile, the Federal Trade Commission is reportedly investigating if Abbott Laboratories and other formula makers colluded on bids for state contracts. The FTC is also looking into whether company coordination affected sales more broadly outside of just the formula supply program. This all according to the Wall Street Journal. Yahoo Finance's Anjali Kamlani joins us now with the details. And I remember those empty shelves, Anj.
Yeah, that's actually where what spurred probably this look from the FTC, looking at whether or not those bids actually give the companies a market domination position. So when they do go out to bid with the states every 3 to 4 years, they stay out of each other's territories of who actually wins that bid. And that's what the FTC is looking into. Now, we've reached out to the 3 dominant players in this, and that's Reckitt Benckiser, Abbott, and Nestle. Perrigo, which is another dominant market player in the non-WIC category, or the non-women's, infants, and children's category, which is what this is all about, does have the rights to produce Nestle's brand, but without the WIC market. So it's an interesting little shift that happened late last year where they acquired those rights, but are not part of this. We do know that Abbott has tried to push back on the inquiry from the FTC, asking specifically to pare back the amount of information that's required. But the FTC has said that it is going to continue to ask for the same amount of information, looking as far back as 2016. And this is based off of a 2015 USDA report showing that there could have been some of these colluding practices. So that's really what the FTC is focused on. Of course, this is just starting. We've reached out to all these companies and none have returned requests for comment from Yahoo Finance just yet. And we do know that this is an ongoing issue for these companies.
Right, and the FTC doesn't always confirm when these things are going on. Yeah. So the Journal reporting this, and we'll see what ends up happening. It could take some time. Another story that we're watching from a health perspective has to do with the U.S. Surgeon General issuing a health advisory yesterday warning that teenagers who use social media more than 3 hours a day double the risk of depression and anxiety. And you spoke to the Surgeon General about this issue. Pretty extraordinary. They don't come out with these warnings very often.
They don't. And it's still pretty much set up as an advisory, which I thought was the interesting part, because they're still waiting to get more data, despite dozens of reports showing exactly what you just talked about, increased pressure on or increased relationship of depression, body image issues, and the like. There is some more data that needs to be collected, according to the Surgeon General. So I asked him, why not go further, and what's holding them back from really launching into this as a full-on warning? And here's what he had to say.
It turns out that, yes, they do have a limit of age 13, yet somehow 40% of kids ages 8 through 12 are on social media. Rules don't help if you're not enforcing them. Second, though, these products have to be designed in ways that optimize and support the mental health and well-being of our kids. And what matters is the evidence that they work. It doesn't matter how many steps and programs we have in place. What matters is the proof that they're actually helping. And when we look at the evidence that's publicly available, we do not see that evidence that they are in fact safe for our kids.
So as you can see, talking a lot about, how it's not safe, also mentioning how it does still provide some community support and the like for those who need the identity and the help from the community. So really interesting to see how much, what they launch, whether Congress decides to fund more studies and what that result will be.
Yeah, wow. Well, the teens need to watch it on social media, and the younger than teens, the tweens. Thank you so much, Anj. Coming up, the currency herd around the world. Why a strong dollar is less than welcome news for emerging markets. But first, we're heading to the NYSE for a check of the market. Let's get right to it. Let's head to the New York Stock Exchange. That's up next. Welcome back. Let's head right over to the New York Stock Exchange now for a closer look at how markets are moving this Wednesday morning. Yahoo Finance contributor Remy Blair is on the ground. Remy, what's the feeling down there?
Well, Wall Street has opened lower on this Wednesday morning with the major U.S. stock averages in negative territory. As we continue to keep an eye on Washington, D.C., on any progress regarding the debt ceiling negotiations, the latest earnings reports are being digested today. Now, at the open, we saw shares of Palo Alto Networks higher, and this came as the company reported an earnings beat for the fiscal third quarter. The company also raised its guidance for the fourth quarter. Now, the company's results in the latest quarter were boosted by growth in demand for cloud-based services. The company's CEO says that it expects an AI transformation to take place within the next 12 months, not just within the company, but within the software enterprise industry itself. And sticking with earnings this morning, Intuit shares open lower. Tax season sales missed forecasts and fiscal third quarter earnings topped estimates. It did see a decline in tax filings, which did hit sales of TurboTax. Its earnings outlook for the current quarter came in lower than expected. Meanwhile, moving over to the luxury goods market as other retailers in the U.S. Report their earnings today, LVMH has extended weakness for the second session in a row. In the previous session, we saw shares of other luxury goods makers, including Hermes as well as Kering and Richemont, trade lower. And because of that downturn we saw in the luxury goods market, shares of those companies wiped off billions of dollars in the market. Now, this sell-off in LVMH comes on the heels of signs of a slowdown in demand in the sector in the U.S. Now, LVMH is the first European company that reached a market cap of $500 billion and traded at over 20 times estimated earnings.
All right, Remy Blair, thank you.
Thanks, Remy. Call it the world's most painful trade. Dollar strength, or at least not more dollar weakness, has been an ongoing story the last few months, despite markets pricing in a June rate pause and eventual cuts. Inflation is gradually cooling, which should weigh on the greenback, but we haven't seen that. A regular victim of a stronger dollar, emerging markets. Just look at Argentina, which is essentially running out of cash as it looks to stave off inflation and prop up its peso. The Turkish lira is another victim. It hit a record low against the dollar this week. When the dollar rises, developing nations usually go all in to defend their currencies against steep falls. The reason is often to protect dollar-denominated debt from becoming unsustainably expensive. Of course, Argentina and Turkey also have their own idiosyncratic political and economic issues, but the dollar does not help. Let's take a step back and look at the wider impact here. Luis Costa is Citigroup Global Markets Head of Central Eastern Europe, the Middle East, and Africa FX and rate strategy. Luis, thank you so much for being here. So when we look at the dollar versus these other currencies, and we look at, in particular, how the EM markets have responded, do you expect that sort of trend to continue? In other words, do you think the dollar should remain relatively resilient and therefore maybe those other currencies not so resilient in this environment?
I think this is the hottest topic now when we discuss emerging markets, generally speaking, with our clients, right? It's the change of we call the broad dollar assumption, right? I mean, if you go back to the beginning of the year, the theme was a lot more in favor of a weaker dollar, and we had the anatomy of the markets was actually pointing this way. We had a very decent divergence between U.S. data and European data. European data a lot firmer, especially when it comes to the sentiment side. And most importantly, your colleagues already mentioned that the China assumption was quite different. We were right in the middle of just China reopening theme. And I think that's, some of these factors I mentioned, they are kind of imploding now, right? I mean, it's quite interesting. To the latter case, the China growth assumption is changing quite a lot. Obviously, it's probably still the case that they're going to achieve 5.5–6% real GDP growth this year. But when on a quarter-over-quarter basis, it's looking on a more high-frequency basis, growth out of China is looking quite tepid. And most importantly, the renminbi is also losing traction, right? I mean, depending on how you look into the equity gauges, it is actually, we are pretty much wiping out the gains in some equity, some stocks or some indices out of China. So I do think that, some of these factors are changing, and it's probably pointing towards a lot more two-way in the dollar, not necessarily a huge dollar mini cycle here or bullish dollar mini cycle, which, as you mentioned, can be very detrimental to EM risk. But it's definitely more two-way here, and it calls for better homework when it comes to getting involved into EM now.
So to your point, Luis, Diane here, there had been, I guess, some talk about the rise of the East and is the dollar's dominance, like are the days numbered? And to your point about the issues with regard to China's yuan, is there a point where we could see that happening more emerging markets like China, especially since they are pushing for a change to the world reserve currency? What could happen? Like, does this debt ceiling debate start to jeopardize the strength of the dollar?
Well, it's an interesting question because, we have seen there has been a secular, and we have written extensively about that. There has been a secular move out of dollar, but we have to discuss the size of this move out of dollar, right? I mean, knowing that, of course, I mean, it's still, U.S. assets or U.S., treasuries, they are still, amply known and regarded as, the safe haven for any FX reserve manager out there. So it's very difficult to get out of treasuries and try to hide somewhere there. And most importantly, I think we are also we are right in the middle of this different cycle, the way international managers see the Chinese market, right? I mean, you probably remember 7, 8 years ago when they were trying indeed to open up the markets, open up the capital accounts to international investors. There was a frenzy, right? There was this impetus to participate now, which is a very large liquid market, right? But, we know that even because of the geopolitical aspect, that lost a lot of traction. So I still find very difficult to believe that this is going to accelerate. Obviously, there's an attempt to diversify assets by FX reserve managers, but not strong enough, not powerful enough to change the dynamics in the dollar for those investors.
In terms of the geographies under your purview, are you finding areas that are indeed attractive, that are good alternatives right now?
Yes, we still find. I think that's, in the emerging markets currencies, and as I say, as I mentioned to my clients, it feels like the broad dollar assumption is changing, but it doesn't necessarily mean that investors should just, flee emerging market currencies. You still have interesting plays. Mexican peso is an interesting play. Brazilian real, interesting play. There are currencies that are still holding a decent amount of carry, right? The differential between the local interest rates and U.S. interest rates, and most importantly, the real rate valuation. So when you take into account whatever interest rates that currency is paying versus the inflation. So especially Latin America currencies, and I mentioned a few examples, the Brazilian real and the Mexican peso, they are still interesting plays. So, but as I said, the homework has to be done a lot better now. In emerging Europe, the story is quite different because this is a group of currencies that never quite offer enough real yields, never quite offer enough carry, right? And with a few exceptions. But so I think it's the story is definitely, as you mentioned, the geographical differentiation. I think that the story remains quite biased towards LATAM currencies still.
Gotcha. Louis, thank you so much for your perspective this morning. Louis Costa is Citigroup Global Markets Head of Central and Eastern Europe, Middle East, and Africa FX and Rate Strategy. Thank you. Coming up, China is bracing for a new COVID wave, and it's sending Moderna's stock, or was sending its stock higher yesterday, but it's given up those gains today. We're going to give you the details next. It is time for today's trending ticker, and Moderna still tops on our list. It surged about 9% yesterday, giving up some of those gains today. It's off by 3%. This after reports that China is bracing for a massive new wave of COVID-19 cases. A senior Chinese health advisor saying earlier this week the XBB variant could drive a peak of 65 million infections per week within a month's time. This wave comes just 6 months after Beijing's sudden lift of COVID restrictions that saw cases skyrocket. This new variant proving resistant to immunity from previous cases. And although its foreign-made vaccines are not approved in China, Moderna shares had gotten a boost from resurgence fears after the news first broke on Monday. And it's not just Moderna, by the way. We are also watching things like casino operators, right? Because we had seen a hit to some of those operators yesterday, the likes of MGM, Wynn, Sands China, as you see there, because if there is some kind of shutdown once again,
right,
if there's a hit to their businesses in Macau, then that can be potentially negative.
Indeed, and as we saw before with previous waves of COVID. So it'll certainly be one to watch. And the point you made as well about Moderna's not even approved there.
Right,
so
it's just more of a sentiment situation than anything else.
All right. Coming up, executives' focus seem to be shifting away from a recession. So what does this mean for the state of the economy? We'll discuss. That's next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Diane King Hall in for Brad Smith today. And we are watching a downdraft in equity markets. I want to start as I did yesterday, this time with what's going on in the bond market, because as we have talked about, there seems to be at least a temporary stalemate in the debt ceiling talks, and that means we have seen, especially the shorter term, the shorter end of the curve, really see an increase. Here's the 13-week T-bill. There is, at least at the margins, concern, will the U.S. not be able to pay off some of its debts? And so we have seen these yields go higher. Interestingly, on the longer end of the curve, though, there is a little bit of relief today. I'd really call it a little change, though, at 3.95%, for example, on the 30-year. And then switch it on over and looking at some of the other areas that we are watching today. Here's the Nasdaq 100, which we tend to like to look at. This one stands out to me today. Tesla shares are down 3%. Not sure exactly what's going on there or what might be to blame, but interesting to see that kind of action here today on a day when, yes, overall, we are seeing some weakness within large cap tech. Nvidia, which is out with its numbers, remember, after the close of trading, down about 1.8% today, but it has been rallying or had been rallying into this before a little bit of a downdraft here. And then let's look at sectors as well here to see what's moving in today's session, what's contributing the most to the selling pressure that we are seeing. Financials in last place here. And we have had some strategists say, listen, look to the financials, look to the banks. Those are going to be the ones that start to react when we do see more debt ceiling reaction in the markets. And there you have it. Industrials and materials also lower on the day, Diane.
All right. Meantime, recession fears have been rippling across Wall Street all year, but they have yet to materialize. And with executives shifting focus to other issues like the debt ceiling, does this mean concerns are in the rearview mirror? Yahoo Finance's Josh Schaefer joins us now. Josh?
Yeah, Diane, so I would say it actually might mean that concerns are further into the future, maybe in some ways, and just maybe kick down the line. But what we're seeing so far through this earnings season, through pretty much the entirety of first quarter earnings season, is recessions have been mentioned less this quarter than they were last quarter, and that's been the case for 3 quarters now. You can see they really peaked in that second quarter of 2022. This is mentions from S&P 500 companies, those executives on earnings calls has dwindled, and it's been interesting to see that coupled with really what we're seeing from economic data that has been very strong. You take a look at yesterday's flash U.S. Composite PMI hitting a 13-month high. And then you take a look at overall what we're seeing for projections for GDP going into for the current quarter. Projections for GDP for the current quarter show growth of almost 3% per the Atlanta Fed. That is obviously not a recession indicator. That would be pretty positive. And then even just look at what we're seeing from earnings right now, guys. You are not seeing recession signs. One of the big things people look for is what are consumers doing, right? We're seeing a lot of strong consumer sentiment right now as far as what they're buying. Ask Urban Outfitters. I think they feel pretty good about what they're seeing from the consumer overall right now, though. And it seems like if we are going to talk recession, it's going to get kicked further down into maybe further into the second half of this year. Or are we talking about 2024?
Right.
Possibly.
Or even if people are spending, they're spending on different stuff. Maybe.
Right.
You know, if I'm a teen, I'm still buying something at Urban, even if I'm not shopping in the clothing section at Target. I don't know. It's very interesting what we're seeing. So how does this all feed back to the Fed and future rate hikes?
It seems like I was talking to Michael Antonelli, the strategist over at Baird, who I know is a close friend of the morning show here, and he said, if we have all this positive data, shouldn't we probably be talking about a hike again more than we should be talking about cuts? And that's what we're starting to see when we talk about the pricing that we see from that CME Fed watch tool. That has come down. The day that CPI was announced on May 10th, there was about a 1% chance of a hike. Markets were pricing in about a 1% chance. Markets are now pricing in about a 35% chance, give or take when you look at it, of a hike in June. And then it's the question of, are they going to pause in June but still lean toward a hike? And it seems like a lot of people are seeing that. And then you spin it out even further. We had been talking about cuts in 2024, right? That was, in 2023. That has been also cut down.
Yes.
And people are not really pricing that in.
June, though.
People are not really pricing in cuts in 2023 though either. And I think that's interesting to start see is basically if you're not seeing a recession materialize right now, the Fed might need to keep these rates higher for longer, which seems to be what Chair Powell is starting to indicate.
Yes, but part of the issue has been the job market. So that's why I'm no market strategist, but they're not going to cut in June.
3.4%, it's the best number since 1969. I mean, it's strong.
I wouldn't
I
count
could
it out,
be
but
wrong.
You never know. All right, thanks so much, Josh. So as we've had this talk of recession dwindling, what does that mean for the state of the economy? Are they right? Jennifer Lee, BMO senior economist, is with us now. Josh brought up a really interesting point here, that we have definitely seen corporate earnings calls, that the discussion of recession has come down. I would say sort of anecdotally on people that we talked to on the show, it's not quite as clear as it was a few months ago. Where's your thinking stand on if and when we're going to go into recession?
Well, good morning. Thanks for having me on the show. You know, just listen to Josh. It just shows how markets and economists, analysts, we've been all over the map. We have, you know what, we are still calling for that recession. I mean, things have slowed, obviously, right? We've had 500 basis points of Fed rate hikes. It's having an impact. Maybe it's not having the big oomph that normally it would have, but things have started to slow. Just look at the retail sales number last week. I was actually at a conference, and somebody had texted me the numbers right away. And I saw the headline and the core number. I thought, oh, great, are we going to start pushing off this recession start again? But you know, but when we look at the details within the retail sales report, it wasn't exactly all positive. There were still quite a few sectors that were down. It'd be like half and half. So things are slowing. Things aren't slowing dramatically, but things are clearly slowing, especially in the factory side. So we are still looking for that negative quarter for Q2 to kick in, for Q2 and Q3. But you know, we've always been saying mild contraction, and we are still sticking by that call.
So you are calling for a recession then later this year and not in 2024 still?
Correct.
Okay. And then one follow-up question I have for you, because since I know you heard our conversation with Josh, what's your expectation for the June Fed meeting? Are you expecting a pause? I can't see a rate hike happening, but what are you expecting?
Totally on side with that. Like, no, we are not looking for a rate hike. Our call has been that last meeting was the final rate hike, and then they would stay at these elevated levels for some time, and probably until 2024, and then the first Fed rate cut to kick in 2024. If there is a risk, and there's always a risk on either side, it will be to raise rates. And right now, I mean, like, the data are not pushing for a rate. I don't think it was pushing for a rate hike per se, but if things continue to remain strong, they're going to be watching things like further job gains, continue to watch consumer spending. I'm dying to see what's going to happen at this Friday's April PCE report. And of course, inflation. And if it continues to stay strong, then we could see another rate hike coming down the road, but I don't think it's going to be in June. But again, base case scenario, that's it until 2024, and then we start seeing rate cuts. And of course, it depends on how all these talks play out. And, if we do see things fall apart, which again is 50-50, and I have no idea how this is going to play out, that, we could see, it's almost a reason for the Fed to actually stay on the sidelines, for at least for now.
Oh, goodness. I hope by the time the Fed meets, we know what's going to happen with the debt ceiling. But, who knows? But I am curious your thoughts on that. I mean, as you said, it's 50-50. Like, it's even tougher to game that out than it is maybe than the overall economic direction, right? But it does feel like the consensus is pointing to a deal, even if it's not exactly by the X date, soon thereafter. Are you guys in that camp also?
We are in that camp. I mean, quite frankly, it's a lot of political theater. Yes. In my humble opinion. But I think that at the end of the day, cooler heads will hopefully prevail. If we start seeing markets reacting very badly in the event that it looks like it's not going to go anywhere, we might go a little bit past that X date if it is indeed June 1st. And then we could probably see hopefully a deal soon after that. And so hopefully it'll be very temporary, I think you said earlier as well. So we'll see how that plays out. But it obviously will be, to borrow, I forgot whose word was, but it was, it'd be catastrophic if they did not, if this thing extends for a while longer.
Yeah, they've certainly kicked the can down the road in the past. I mean, we've been through this before, to your point, 2011, 2013. I mean, time upon time again. And, some voices say we should just do away with the debt limit. That's a separate conversation altogether. I want to ask you really quickly also about the job market. That's one of the things, one of the areas of the economy where there has been continued strength and unexpected strength, and particularly like in the last report. Are you expecting to continue to see that strength when we have the next report coming up in just weeks or less than a week now? Or about a week.
Next Friday. We're still looking for something, on further job gains, maybe a little bit of an uptick in the jobless rate. But it's still going to be ongoing jobs. We're not going to see obviously 500,000 jobs again, but something around the 200 level or so would be considered a decent gain. And of course, whatever the breakdown is going to be, and then of course what happens to earnings. But all of this has been like the overriding feature, I think, for this entire situation is that, and the reason why we continue to call for a mild recession is because the job gains remain strong. There's still talk about hoarding. Our businesses are reluctant to let go of a lot of their workers because they know how hard it is to hire them back. And of course, wages are still rising, or maybe at a slower pace, but still rising, and that's helping consumer spending, and that's what's going to cushion this entire recession.
And finally, I want to widen out and look globally for just a second here, because we earlier were talking about a potential COVID surge in China, and even there, growth is not what it was, right? And if you look around the globe, maybe other areas have been a little bit more resilient. But as it pertains to U.S. growth, what's the sort of dependence on the global economy at this point? And is that going to be a curb on U.S. growth or help it at this point?
Having other economies continuing to grow, Europe has been beating expectations. The UK as well, managing to circumvent a recession, which is positive news. Doesn't mean that everyone is out of the woods just yet, because it's the year is still young. Inflation is still, especially in the UK, it's still very, very high. So that is going to weigh, I think, overall on broader global growth. China, had a big strong start to the year thanks to very weak year-ago levels. But we still see China, meeting their growth target of about 5.5%. So that would overall help the global growth, and of course help the U.S. as well. But the U.S. is obviously going to be the big driving force, and we need to make sure the U.S. continues to move in that direction before we start talking about things like a global recession.
Right, Jennifer. Always good to catch up with you, Jennifer Lee, BMO senior economist. Thank you. And we've got to take a look at a trending ticker that we are watching today. It's XPeng. Investors are pumping the brakes after the Chinese EV maker forecast a steep decline in car sales. XPeng now expecting between 21 and 22,000 deliveries in the second quarter. That would be a 36 to 39% drop from the same quarter last year. Those shares pulling back by about 12% in U.S. trading. Coming up, debt ceiling and inflation. They're weighing on American wallets and minds and people's mental health. We've got some tips to ease financial stress up next. A quick check of the markets now, sponsored by FlexShares, about 45 minutes into the session, and markets holding down here. In fact, the S&P and the Dow in particular worsening a little bit. The Nasdaq off by 0.75%. No positive news about progress on the debt ceiling. That finally seems to be feeding into some stock market weakness, perhaps. Today, money is causing Americans more stress than anything else. A Bankrate survey finds that 52% of Americans say money is having a negative impact on their mental health. When you turn on the news, there's no question why people are so concerned, with some of the top financial concerns in the survey being inflation, debt, and rising interest rates. And you don't have to turn on the news. You can go to the grocery store or anywhere else where you're spending money. Joining us now with tips to ease that strain is financial advisor Michelle Arpin-Bagina, and she is with Michelle AB. Thank you so much for being here. So when you are talking to clients about this kind of stress, besides maybe some like yogic breathing or something, what are some of your top tips and counsels for them?
Yeah, thank you for asking. It's great to be here with you. The first thing is we have to recognize the difference between stress and anxiety. And what the research is really showing is that people are feeling very anxious. But most people are not going to say, I'm anxious. They'll say, I'm stressed. And part of what needs to be distinguished is, what are they worrying about? Are they worrying about an event that has happened, or are they worrying about events that could happen and the impact of, like you said, rising rates or the debt ceiling or stock market reaction, their job security? So first, distinguishing that. What people really need is a space to talk about these things. So the first thing that I want to know is, what's the impact? Are you losing sleep? Is your mind preoccupied with worry? Are you feeling depressed? Because believe it or not, the first piece of advice I'm going to give people is to take great care of themselves. That might mean sleeping well, exercising, getting some fresh air, being with some family and friends, because there's a connection between our anxiety and our cognitive abilities to think clearly, to be in a good mood, and to make good decisions. Beyond that, separating out what is within your control, right? Is this a worry about systemic issues that we have very little control over? Or can we zoom in and say, let's look at your personal situation and figure out where you might want to act and what you might be able to do about some of the things that are being presented in your life?
Michelle, I want to ask you, so you point out some great tips that people can do with regard to kind of just taking a step back and being more mindful, et cetera. But there's some practical things people have to think about, especially when there's another data point I want to mention. There's a recent Fed survey that shows adults who are worse off financially in 2022 than a year earlier. That number climbed. So practically speaking, there are some practical steps that people would have to take to deal with their financial circumstances. I mean, like, sure, there are things beyond your control, to your point about some systemic issues. But what would you say are the top 3 things people need to do, practically speaking, that can also affect their mental health and their financial well-being, if you will?
Yeah, thanks for asking that. From a very practical financial standpoint, I think first is it starts with the budget, right? This is a time to be intentional and to be really efficient about where money is being spent. So, for example, add to your cash reserves if you have extra money where you're able to do that, and take advantage of some of the best cash rates that we've seen in at least 15 years. Lock in some CD rates. Like this morning, CD rates have jumped to, over 5.4% on a 15-year CD. So really looking at, what are you spending? How are you utilizing your cash? Look for bargains, right? Technology has made that easier than ever to spend our money more efficiently. Ask for a raise, right? Some of your former guests on just this morning are talking about how strong inflation is for wage growth right now. Now may be the time to ask for that. And last but not least is play the markets, right? This is not a time to reduce your stock or bond allocation. Stocks build compound wealth. They're often one of the best inflation hedges that we have. Just take 2021, for example, where the markets were up 21% when inflation popped about 7%. Look at trends in your portfolio. Make sure you're diversified. So, for example, a trend might be artificial intelligence right now. Don't overdo it, but maybe there's a slice here where you're looking forward and starting to compound your wealth based on just current trends that are outside of the trends that we're hearing around the debt ceiling or inflation. Reallocate to corporate bonds. Some of the places that we have most of our opportunity in the market are really opportunities that we have not seen in a long time. Like I mentioned, CDs and corporate bonds.
And to your point, just a quick follow-up, Michelle, what do you think about, because to your earlier point about some systemic issues, what do you think about those state income experiments? Do you think more states need to do something like that where they have like a certain guaranteed income or there's a cash infusion to a certain demographic in terms of addressing, like, I mean, we've seen this statistic before where many Americans can't even cover a $400 emergency expense. What's your thought on that, the state income experiments?
I think everything should be on the table, is my opinion, right? This is a new world that we're living in, and we should be experimenting with all different types of solutions for all different types of people, because, you know, each one of us is different than the next in our abilities, our opportunities, our capabilities, and how we want to live our lives. So I'd say put it on the table.
Michelle, when you talk about maybe reallocating some more resources for people who maybe are not putting anything aside or enough aside, whether it's in stock investments or in some kind of retirement fund, at a time like this of financial stress, how difficult is it for you as an advisor to convince those people that those steps need to be taken? You know, maybe a short-term stress for a longer-term gain.
Yeah, this is an age-old conundrum, right? We're as human beings, we think very much in the present to keep ourselves alive versus thinking about our future self and what we need to do now to make that person secure and happy later. So it really just comes down to a simple thing of asking people to do what they can in the moment. And, you know, probably everything that I've mentioned, I've said this is really about personal responsibility, because so much of the issues are systemic that we can't control them, which also could make people feel like they're shouldering the burden of, you know, lots of different situations. But at the end of the day, it is in our hands, which is a positive, to be able to make positive change, to reflect on what it is that we do and we don't want, and to take action. Usually taking action, even a small little action, like I'm going to start putting $10 a week away to build. It makes people feel better when they're doing something about their situation.
I like that, Michelle, especially because, you know, you talk about the feelings involved around money, and sometimes there's a shame factor, especially, let's say, with some people who are higher educated or highly educated, rather, and feel like they should be better off than where they are, and kind of hide from just even showing the numbers to someone. So, Michelle,
yes.
I just want to put a bookmark in our conversation. We'll certainly talk to you again. We appreciate you so much for joining us. Our thanks to Michelle Arpin-Bajina, Michelle A.B., founder and financial advisor. The segment is sponsored by FlexShares. We appreciate you, Michelle.
Thank you. Thanks for having me.
All right. Coming up, how Qualcomm is tackling the future of generative AI. We'll share our conversation with an executive from the chip maker. That's next. Qualcomm building on its partnership with Microsoft yesterday, unveiling new features to scale on device AI. The announcement at Microsoft's Build Developers Conference means further integration of Qualcomm Snapdragon in Windows devices. Akiko Fujita and Ali Garfinkel spoke with Qualcomm's Senior Vice President of Product Management. Let's take a listen to what he had to say.
I think this generative AI opportunity is just amazing for Qualcomm. You have to understand that this is how we're able to bring all of these experiences onto the devices that are in people's hands. Right now, many of these generative experiences are sitting in the cloud. So people at large are not able to access these experiences. But now, whether you think about productivity applications on PC-like devices or other entertainment-like applications on smartphones, with this change that's coming right now, with the technology that we have been building, we can actually bring all these experiences to the edge devices, to your PCs, to XR products, to smartphones, to IoT products, and that's really the amazing opportunity for Qualcomm. And we believe we have some unique, differentiated technology that sets us apart from everybody else in this space.
Ziad, Ali here. Investors aren't necessarily thinking of Qualcomm as an AI stock, but should they? How big of an opportunity is Qualcomm looking at in AI?
Oh, absolutely, right? So think about it. If you think from the perspective of privacy, if you think from the perspective of the contextual data that's available on a device, to be able to run these generative AI use cases, large language models on the device, it completely changes the story. It allows people to be able to run these devices while keeping those queries private, to be able to generate that experience even when you're not connected, to be able to use the contextual information in a way that basically you can give a far better experience to the user than is possible today. So let's take an example, right? So if you're talking about you're creating a virtual world around you, if you already know the kind of textures, the colors, the themes that you like, we can actually optimize that experience for you. So the experience is better, the privacy is basically preserved, you have the experience whether you're connected or not, and essentially the experience is far better. So we really think this brings the generative AI opportunity to the edge and really moves the center of gravity towards edge devices. So it's a massive opportunity for us at Qualcomm.
Yeah, I've heard you say over and over about the experience here. It feels like we're just really at the tip of experiencing generative AI. What does that future look like? When you talk about user experience on your smartphone, what are we talking about?
You know, let's take an example, right? So on the smartphone right now, you take a picture, already we are using AI to be able to enhance the quality of that image. But what we can do now is you can literally talk into your smartphone and you can say, well, put me in front of the Eiffel Tower at sunset with the beautiful clouds in the distance. And you know, we can go and run a text-to-image model that actually generates that background and puts you right in front of it, right? That sort of an experience, that sort of an interactive experience on devices is really truly only possible if you can do this on the device. And you know what makes this possible is our special hardware. Our pedigree is about doing more processing at the lowest power possible. And that's precisely what we're able to do with AI too. And we can essentially do that on a device that's not plugged. Whereas some of our other competitors run it on, you know, graphics engines that takes hundreds of watts of power, will literally do these experiences with milliwatts of power. And that's what takes it to the masses. That's what takes it to every user that uses a smartphone at this point in time.
Ziad, we've heard a lot about AI risks in the context, for instance, of ChatGPT, which kicked all this off. But I'd love to hear a little bit about how AI risks look from your vantage point.
Yeah, so I think one of the main concerns that people have with some of the generative AI examples is privacy. You have seen some of the news come out recently about certain information getting out and staying and residing on these cloud servers. Well, with AI, generative AI running on the device, that query, that question that you ask from a text-to-text-like example stays precisely on the device. It never leaves it. So actually, we are able to address some of the concerns that people have. Of course, additionally, the models have continued to get better. That will actually help with doing a lot more in terms of improving the experience and taking away some of the concerns that people have with these generative AI use cases. And of course, what is also going to happen is that people will actually get to use these experiences. I think this is a seminal moment in our industry because it really changes the way we interact with our products, with our devices. And this is not one of those things that kind of follow the hype curve. This is actually an example where we have customers coming out to us today and saying, I want to run these use cases on the device. So this is very true. And this is where we believe that we'll be able to actually address a lot of the concerns that people have. Another big, very quick concern that people have is the cost. right? If you can imagine that these models are getting larger, the applications are growing, at the same time, a lot more people are using them, you will get to a point where you will not have enough resources in the cloud. So you actually need the edge to be able to do generative AI. And that's the unique opportunity for us.
So I'd love to take this a step further then and say, is it possible that the technology you're talking about developing at Qualcomm will make ChatGPT and apps like it more accessible and less costly?
Absolutely, right? So what we can do today, what we showed at some of our recent conferences was a 1 billion parameter model, what we call stable diffusion, running entirely on the device. We showed it today at Build, where that same model is now running on a PC. Now, what we have a roadmap for is to be able to do up to 10 billion parameters models on the device. And you can envision some of the models that are out there today, text-to-text like models, and we see on a daily basis new modalities coming into it. Text to music, text to audio, image to video. All of those, many of those actually fit very well in this range that I'm talking about, which we believe can run comfortably on the device in a sustained fashion. And that's why it comes to everybody. It comes to anybody and everybody that has a smartphone or a PC or an XR device, not just connected to the cloud at this point in time.
And that was Yahoo Finance's Akiko Fujita and Ali Garfinkel speaking with Qualcomm Senior Vice President of Product Management. Coming up, putting the metaverse to work, how surgeons are preparing for real-world scenarios within the safety of virtual reality. And by the way, it has nothing to do with the company called Meta. We'll have details next. Meta's Reality Labs division cost the social media company almost $4 billion in the first quarter alone, weighing heavily on profits amid Meta's so-called year of efficiency. The company is now aiming to drum up support by pitching the metaverse as a haven for job training and education. That's familiar territory already for HTC. Their Vive headsets have been put to use by surgeons and firefighters, allowing high-stakes training in the safety of a virtual world. Here to discuss is Dan O'Brien, HTC America's president and global head of enterprise. Thanks for being here.
Thanks for having me.
It's so interesting to me because we talk about the metaverse. We see, Mark Zuckerberg legless moving around a meeting, but we already are seeing in-use applications for this stuff. So talk to me about HTC's where is it being put to work?
Sure, and I think, metaverse in general has been kind of really grandiose and everybody thinks it's this new thing that has to happen right away. It is down the road. It is something that actually will evolve into, but right now there's a lot of real world applications, professional use cases, whether it's in the public sector, healthcare. We are seeing, architecture, engineering, construction, great efficiencies, training and simulation, designing new products. This is across the board. Like, these are real applications being used today. We all have a version of the metaverse, but we have something we call the Viveverse. But this is for businesses. This is for corporate use. This is for benefiting your company. This down the road, this avatar and all of us kind of interacting with each other, that's things that are going to happen down the road. And there's a bunch of hurdles that we actually have to solve to get there before that can become a reality.
So I have two questions for you now then. So first, the hurdles, I imagine some of those are legal hurdles. And then, but actually before you get to that, you made a comment to us before we got to you live with this about immersive products like the VR headsets replacing this and being just as in daily, as ubiquitous, that's the word I was looking for, as the smartphone.
Right.
How can you say that?
Well, we made a huge leap this past year in building what we call the XR Elite, which is something that's on the realm of just glasses. These products, we will introduce radios into them, just like that is in your smartphone. We have a long history of making smartphones in what we call radiated endpoints or terminal points, which is a smartphone. These products will become connected. That needs a Verizon Wireless, an AT&T Wireless, a T-Mobile, a Vodafone. You will see 5G networks and eventually 6G networks in 2030. Where you will actually have connected wearables, and then you'll see headsets that actually have multifunctionality of mixed reality, where we can see the real world as well as digital overlays and digital introductions. And then things become much more ubiquitous and easy to use. But you actually have to deliver content to all of these wearables wherever you are. That's a huge hurdle to solve.
So part of that is the technology then and getting to that 6G or what have you. What about the human element? Because we've seen some of these products come out before. What was it? The Google Specs, right? Snap had the spectacles, I believe they were called. And
they were just trendy.
People got made fun of. There was that, there's that sort of aspect of sort of cultural adoption that sometimes can be a big hurdle.
That's right.
To solve.
So that's why we start with, our company actually stands for innovation, technology, and humanity. So all the solutions that we've been focused on since 2015, 2016 has been solutions that actually bring value, whether it's cost savings into your corporate environment, efficiencies of collaboration in designing new products, or training nurses, doctors. We fund actual developers that create solutions to train surgeons.
So in other words, down the road, it has to be worth it for me on a consumer level to wear these things. It has to bring me something that my phone.
And on the consumer level, you really don't see anything outside of gaming right now, which is a smaller audience.
I was going to ask that because what is the use case besides just
gaming and entertainment?
Yes, exactly.
Right. So what some companies can fall into that are kind of thinking, I guess, with an infinite mindset is if they're just thinking about the short-term play and just trying to get a number of users to just play a game or play something like that, they're really not playing the long game. The long game is actually bringing the headsets and the technology into lighter, more wearable, easier ergonomics, connected to a network, and then actually changing out the use cases. Once you can actually start interacting with phone calls, once you can start interacting with content that's actually valuable to you from a consumer level, you'll see that broader adoption. But right now, we're still in early adopters and enterprise use cases.
And what's the expectation for what the market value will bear out in terms of the overall market value globally? Because, for instance, this week, China announced a state-backed metaverse platform. What's the expectation for, say, within the next 5 years?
Sure. I mean, looking at like Citi's evaluation, they expected it to be a $13 trillion, economy and business. And I think that shows one significant opportunity to actually grow into the different use cases. But I do think that overall, we will see a very, very aggressive growth. Over the next 2 years, we'll see really great adoption across financial services, banking with the use of this technology inside of their corporate environments, whether it's training, simulation, hard skills training, soft skills training, collaboration. And then I think what you'll see is kind of very similar to smartphones.
I don't know.
How that was, how we brought that into our lives, and then how we brought that into our consumer lives. You're going to see a very similar trend with immersive technology and products.
Just really quickly, there's immersive technology, there's AR, VR, and then there's the metaverse. And I think the fact that we still don't really understand what the heck the metaverse is part of the issue here.
Sure.
What is the difference? How should we even think about it? Is the metaverse really a thing, or is it just immersive technology?
One, it's today the metaverse is the internet, right? It's what we interact with from a digital standpoint. Without going too far into what the future scape of trying to understand it is, today the metaverse is an intranet use case inside of a corporate environment where you can use it for these 20 training simulations. Now, that will then be able to be connected to your regular internet. And then you'll be able to actually have brands and things of that nature get involved into, consumer products and consumer adoption.
So it becomes a metaverse when it's bigger, basically.
Yes. Right now, it's small pockets of interactive experiences. And today we do that with automotive, aerospace, healthcare. In these specific segments, we bring strong value and efficiency into these companies. And then we look at this broader thing down the road. But we will actually see, the inclusion of, the Verizon wirelesses of the world and the AT&T wirelesses of the world to actually then bring that fruition to the forefront.
All right, well, next time, I guess, maybe we do this interview in the metaverse with our avatars. I know, I'm a skeptic too. That's just, I don't see this replace that fast. But we'll see.
It's going to happen.
Okay, all right. You heard it here first. All right, our thanks to Dan O'Brien, HTC America's president and global head of enterprise. Coming up, rise of the robots. We'll speak with one company that's taking on Boston Dynamics in the robot race. Wow, that's a little creepy. That's up next. The artificial intelligence takeover is escalating as big tech companies like Microsoft and Alphabet double down on their exposure. But one company is already taking it to the next level. Figure has announced a new funding round today as it pushes forward on its development of its autonomous humanoid robot. Brett Adcock, Figure founder and CEO, joins us now alongside Yahoo Finance executive editor Brian Sazi. So, Brett, let's get right into this. The robot, what is its purpose?
Yeah, well, thanks for having me on this morning. So Figure's designing and commercializing autonomous humanoid robots. These are robots that have 2 legs, 2 arms, hands, can basically operate in a physical environment similar to humans. Our vision here is to deploy these robots to do physical labor. So we want these robots to do, physical tasks in the real world, such as warehousing, manufacturing, retail. We see enormous amount of unemployment happening and just an overall kind of like flat line in the amount of people in the workforce. And we really hope humanoid robotics can help on the automation side, kind of fill that void and do jobs that are dangerous, monotonous, boring.
Brett, Brian here. Good to speak with you. $70 million, it's a lot of money. Where are you going to spend it? And do you have orders for these products yet?
Yeah, well, first off, we announced a $70 million Series A today, led by Parkway Venture Capital and a bunch of other just really great venture capitalists and investors. We're going to spend that money on 4 areas over the next 24 months. The first is overall robot development. So we've finished our first generation robot that is fully assembled, moving in our lab now. We're on to our second generation. We're working on manufacturing. We're building out and designing an end-to-end AI data engine. And then we're working on our commercial go-to-market. On that topic, we are in pretty deep discussions at this point with a few of the top tier kind of, household name groups in the US to deploy the humanoids into areas where these companies are seeing like significant labor shortages and overall jobs that are dangerous and repetitive that we can go in and help automate.
Brett, I'm curious why it has to be humanoid. In other words, I think about, for example, an auto assembly line where a lot of that is automated by different types of robots, I guess, functions. What are the situations where specifically a humanoid would be necessary? Like, give us some examples.
Yeah, I think like for the most part, so many things have been automated today that are relatively easy. So you walk in a manufacturing facility and warehouse, anything that could be automated has basically been done. We think the advantage to a humanoid form is being able to do anything a human can in the physical world. So that means in a warehouse, that means interacting with shelves, moving items, unloading trucks, depalletizing, restocking shelves. We view like the labor population at this point. Basically, labor population is flatlining globally. Baby boomers, demographically, the baby boomers are retiring. We haven't had as many children as we probably want. And we're basically having a huge issue in the labor population. So in the US alone, there's almost 11 million jobs that are just not wanted. And we really hope humanoids can basically move into a world that was built for humans and seamlessly interact with that world and do work. So our goal is to put humanoids in these initial areas in warehousing, manufacturing, and retail to basically fill that labor void. Over time, our humanoids should be able to do anything a human can. That will take like a lot of time and development for us to get all the way there end to end, but that's the aspiration we have.
Brett, we were just showing a side-by-side graphic, your robot versus Tesla's Optimus robot. How far ahead is Tesla? Are they even ahead at this point?
Yeah, I can't really speak to like maybe what Tesla's doing internally, but at least for us, we finished our full-scale development of our humanoid in December. We just got the robot fully brought up and put together a few months ago, and as of last week, we did our first robot steps. So the robot actually did its first, basically steps in the office, like our first baby.
Brett, what was the office vibe when you saw that? That's kind of creepy.
It was incredible. I mean, we worked so hard for last year, and to see something actually go from digital, say software or CAD into like a physical, embodied robot and actually work was just a huge payoff for the team. And now coming off this funding round, we actually have the capital to make really large scale investments into the engineering and product side. I mean, we're roughly 50 people today, and it's, arguably one of the best teams in humanoid robotics. So yeah, we're all pretty fired up, and we basically have, a vision now into the next 24 months to demonstrate commercial viability and then ultimately getting to market and proving that humanoids can be, helpful to society.
So to elaborate further, or to take Brian's question out further, Brett, just about the competitive landscape, what does it look like for you when you think about, because first, initially when you saw stuff like this, you think Boston Dynamics, and now you have the Tesla bot and you all. So how are you all going to stay competitive with a heavy hitter like a Tesla? Again, I agree, this is a little creepy to me.
So I think like the heritage in humanoid robotics the last 10 years has been like very deep into R&D. Like there's been a lot of research and development groups like Boston Dynamics, IHMC, Honda had ASIMO project. So Toyota had a project doing humanoid robotics. For us, we look at where are the commercial groups looking like? Who's got robots that can walk, can have hands that can manipulate and move objects to the world, have the right capital to really get this done, and have the right commercial viability to bring into market. We think there's very few companies in the world that have the ability to kind of do that today. I think what Tesla's doing is incredible. We're watching from afar and rooting for them. And here internally, we feel there's a chance for us to hopefully in the next 24 months demonstrate and then commercialize the technology, which I think will be really incredible. I think that'll feel like 50 years of the future got pulled forward. And I think having humanoids in the economy will be just a huge benefit, and we can really help fill a really big void in the economy that's happening today.
Brett, you're probably familiar with the comments that Elon Musk has been making pretty consistently about AI and the dangers of AI, and he's not the only one. And we referred frequently in this conversation to the creepiness, right? There was this unsettling nature to having a humanoid robot. If you've got a humanoid robot and AI, how do you reassure people about that sort of psychological, emotional response to something like that?
Yeah, I think it starts from the top. Like our goal is not to basically develop and design an unsafe product. We won't do any military or law enforcement work ever. I wrote about this in kind of the company manifesto. And, we spend a lot of time on cybersecurity, just the hardware side of things and the software side of things to make sure that we're designing a safe robot. We're ultimately designing an electromechanical robot, so it's fully electric. I would almost think of this as almost like we don't want to design a very heavy duty robot. We basically want to design a robot that can basically do the minimally viable of what humans can, move light payloads around, help do work. So we're really designing a labor tool. We want to basically design, automation that can help the world and do all these things in the economy that we don't have people to do today. You walk in any manufacturing or warehouse facility today, it's not as if we were taking people's jobs. They're having, 2% weekly attrition, over 100% annual turnover. These jobs are walking 10 plus miles a day, picking 50 items an hour in very hot warehouses. We feel like there's a real need to help fill this problem in the society, and we hope that a humanoid will be able to interact with that. So our view is to hopefully design a really important product and a really safe product that can do well for humanity long term. And I think there's a real path to do that, but we have to do that very thoughtfully.
Right, and it not necessarily thinking for itself and becoming our new robot overlords. It sounds like more of a service tool. Brett Adcock, a Figure founder and CEO, really fascinating conversation. Thank you so much. And Yahoo Finance executive editor Brian Sozzi joining us for that convo as well. Thank you. All right, let's do a very quick check in the market, sponsored by Flex Shares. We've got markets that have taken another leg lower. The Nasdaq now leading declines, off by more than 1%. Coming up next, Rochelle Akufo has you for the full hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akutho. Here's a look at what I'm watching this morning. Debt ceiling talks not going well. House Speaker Kevin McCarthy says the parties have yet to reach a deal, avoiding an unprecedented default. We'll tell you why this Friday, the 26th, emerges as a key date. And eliminating the swipe cycle. AI is the word, but could it help you with your dating life? We speak with a company looking to streamline the process using the technology everyone is talking about. And a silver lining amid the retail doom and gloom. Kohl's reporting a surprise quarterly profit amid a push to reinvent itself. We take a closer look at another retailer soaring after strong numbers. But first, let's check in on the major indices. See how they're feeling this morning as we're still seeing these jitters reverberating as we draw closer to that X date on the debt ceiling. As we see here, the Dow now off more than 240 points, 0.7%. The S&P also under pressure there, down 0.9%. Tech-heavy Nasdaq bearing the biggest brunt so far, down more than 1% or 140 points. Let's also check in on the Treasury market as well, see how those jitters are affecting that. We see the short-term yields there just barely up. They're about 1/3% here. The 10-year also up just barely, 0.1%. 30-year as well, just barely in positive territory there as well. A real holding pattern here as we await what we hear from these debt ceiling talks. Well, of course, the debt ceiling saga continues with no deal on the table yet. Investors are getting antsy as the long weekend gives Congress fewer days to review legislation, vote, and get a bill on Biden's desk to sign. Joining us now with more on this is Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. So as we really look at the countdown here, I mean, we have a weekend coming up, we have Memorial Day coming up as well. Markets will be closed, really anticipating this. How much of a make or break is what happens by Friday for markets?
I think the markets are paying really close attention, and what happens by Friday will be important. I think what's also important to highlight, in 2011, deal was made over the weekend and then, shortly made into law the following week. And so we could still see something happen over the weekend, even over a holiday weekend. And so, Friday is not the be all end all, but I think the market really is going to want some sign that progress has been made by Friday.
And when we look at what markets have already had to price in so far this year, I mean, deciding whether or not there are going to be Fed rate cuts, really jumping the gun here. They haven't even had the pause yet, and they're already jumping ahead to potential rate cuts here, despite what we're seeing with stickier parts of inflation, especially in services. What's your estimation for the potential for a Fed pause or cuts at this point?
I think, it's going to be very data dependent. There's a lot of data coming out between now and that June meeting that can, push the Fed to either raise 25 basis points or to pause. And I think what will be key is to not misinterpret a pause in June as a sign that the Fed is ready to pivot. I still think that even if the Fed pauses in June, there's still a likelihood that they may have to raise rates still later in the year because their primary objective is to get that inflation down. And while it has come down meaningfully from last year's peak, it's still stickier than where the Fed would like to see it. It's still above that 2% target. And, a lot of Fed officials have spoken recently, really reiterating that mandate that they need to get that inflation down.
And so when you look at how close we are, even just sort of seeing some of the volatility building up because of the debt ceiling standoff, and you add that to recession expectations, then we might not even know how long these reverberations will last as markets sort of get to terms with all of this. So what are the expectations here? How deep and prolonged then could a recession be?
I think, we are expecting a recession starting later this year, maybe extending into 2024. We're not expecting a very prolonged recession, and we think we can look toward a recovery in 2024. I think that will be really key for markets, that expectation that a recession will not be very long. And what's really underpinning that is the strength that we are still seeing in the consumer and the strength that we're still seeing in the labor market. Even through a recession, we're not expecting the consumer and the labor market to weaken as much as they may have in previous recessions. And so that should help keep that recession on the shorter end as opposed to the longer end.
I mean, when we look at equities so far this year, you caution not to chase the equity rally. What are some of the risks you think investors might be missing?
Well, investors are very focused on this near-term risk with the debt ceiling. underpinning that, we've got, a risk of recession, a risk that the Fed is going to be a little bit more aggressive in policy than what the market is expecting. You mentioned earlier, the market's expecting cuts this year. We don't think that's going to happen. And expectations for cuts have come down as more Fed officials have spoken for 2023, but there are still some cuts priced into later in 2023. And when that doesn't materialize, the market's going to have to react to that. So I think, a more aggressive Fed, a little bit more aggressive than what they may be expecting now, is something that, the market is going to provide a lot of market volatility through 2023.
So then for people looking at their portfolios, wondering sort of how to hedge some of this, not just the inflation risks, but recession risks as well. Some sectors that you say that you like here, healthcare, IT, and energy. How are you allocating some of these things?
Yeah, our key has always been, don't exit the equity market, but to shift that positioning to be a little bit more defensive. So shifting from the more cyclical sectors into things like tech, healthcare, energy, because we think that they're going to be more resilient through the economic downturn. And we've had this defensive positioning for over a year now, beginning of 2022, when we first started seeing the stock market decline. And that has, that's worked out well for clients, that's worked out well for us. And we think that those are the areas that are going to hold up better than other sectors within equities as we're navigating all of this volatility through 2023.
All right, don't chase that equity rally. Great stuff there. Thank you so much. Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. Thank you so much. Well, today's weakness notwithstanding, we've seen a surge in mega caps recently, with the rest of the market trying to play catch up. Over the last few weeks, investors have dialed down their expectations for an aggressively hawkish Fed while pricing in a much softer landing. Whether or not that materializes is debatable, but what's the bottom line for investors? How do they navigate a market environment where the Fed is in a wait-and-see mode? Yahoo Finance's Jared Blickery is here to break all of that down for us. Hey, Jared.
Hey there, Rochelle. First, we can take a look at the Nasdaq 100 year-to-date performance, and we got some oohs and ahs here. NVIDIA, Meta have doubled. We know this, but you were just saying we have to go back to the last Fed meeting. Something really important happened at the beginning of the month, and at that time, just before the meeting, investors were expecting a hard landing. They were pricing in a recession, 4.5 cuts by the end of this year. After the last meeting, that number rose to only 2.5. So investors are thinking, all right, soft landing now, and we've seen growth stocks, and especially the mega caps, just take off. Now, this is the 10-year T-note yield. This is the beginning of May. That's when we had that Fed meeting, and we were right down testing these lows right by about 3.2, 3.3%. Since then, we have actually risen. And let me just show you the implications this is having on the stock market. Now, this is the Nasdaq 100 versus the Nasdaq Composite going back about 30, 40 years. This is the dot-com bubble and crash, and we can see huge outperformance here, and that would be by the mega caps at the time. Guess who they were? Intel, you look at Oracle, Cisco, even Yahoo. So at the time, we did see a lot more outperformance than we are right now. Here's what's happening this year. That little blip right there is the huge outperformance we're seeing this year with respect to the mega caps. So just want to point out that we can see a lot of more outperformance potentially if we were to enter into some kind of bubble mode. Is it AI? I don't know. That's just speculation. But let me show you the investment implications. The last time we had a major, and this is during the global financial crisis, the last time we had a major pause. That would be in, I believe, June of 2006. The Fed kicked off a pausing that would last until September. That's when they cut. And guess what? That was a really good time to be in the market when the Fed was on pause and investors just waiting for that first cut. Here's what happened over that roughly 14-month span. And these are all the markets I'm looking at. At the top here, this is emerging markets. You might say, well, why would emerging markets be the number one outperformer? Well, it has to do with relief because the Fed had been raising rates and it was attracting capital into the United States, and all those investors wanted to benefit from those high rates. So when the Fed paused, guess what? Emerging markets, well, it's their day to shine. So we saw emerging markets up 52%. After that, energy was up about 34%. Really interesting because if you're tracking the price of crude oil, as we're doing through USO, you can see that USO was rather depressed. But in fact, not only energy, but all 11 sectors in the S&P 500 did very, very, very well. Here's tech. Tech was up about 29% over that 14-month period. Here's gold. Gold up about 20%. SPY, that's the S&P 500, the benchmark, up just short of 20%. And then euro. I use the euro here as a proxy for the US dollar. That means because the euro was net up, we saw a little bit of weakness there. And I did want to point out finally that, yeah, global financial crisis, guess what? Financials were under a lot of pressure. Even those were up just slightly by the end, but a clear bifurcation of the returns. And so if we dial it back to the present time, what's going on here is quite a bit different. And I would say the debt ceiling, just another kink, to add to the rest of it. How is it going to play out in the end? We don't know. But I just want to finish with this. The debt ceiling has actually added liquidity to the economy. And when the debt ceiling is eventually resolved, which it will be, disorderly or not, guess what? We're going to see the Treasury issue massive amounts of bills again to catch up, and that's going to drain money from the economy. So that liquidity is going to evaporate. But the bottom line is, when the Fed pauses, and we don't know if it's pausing just yet, we don't have confirmation, it's actually a pretty good time to be in the market, Rochelle. You just got to be in the right markets, of course.
And there you go. Well, with that fantastic breakdown, though, people can't say that they didn't have an opportunity to learn. Great stuff. Jared Blickery there for us. Thank you so much. Taking a look at chip maker Analog Devices reporting second quarter earnings before the bell, beating the street's expectations for earnings and revenue, and seeing a record sales of industrial and automotive chips. Now, despite the solid numbers, you can see shares sinking over 7%, more than 8% right now. The company warning of slower sales in the second half of the year. Now, CEO Vincent Roche in the report saying, looking to the second half, we expect revenue to moderate given the continued economic uncertainty and normalizing supply chains. Now, this isn't far off from what other semiconductor companies have been seeing as well. You have AMD and Intel both reporting declining chip sales and major losses in their most recent quarters as well. Right, coming up, working harder and smarter. We're diving into Bankrate's report on the state of side hustles in the US. That's next. Let's do a quick check of the markets, sponsored by Flex Shares. Still seeing that selling action continue, though, off the session low so far this morning. The Dow, though, still off about 230 points. The S&P 500 also down about 33 points. Only energy, the only sector in the green there for the S&P. FANG stocks putting pressure on the Nasdaq, and Tesla as well, weighing on the Nasdaq as well. That's off more than 118 points so far. Well, Urban Outfitters snagged several price target upgrades from Wall Street analysts after beating in first quarter net sales. Yahoo Finance's Shauna Smith joins us now with a breakdown. Hey, Shauna.
Hey there, Rochelle. Well, Urban Outfitters certainly a standout here among retailers this quarter. Shares jumping this morning here, really posting one of the biggest intraday jumps that we have seen in a couple of years. Now, this comes after it bucked the sector's trend this earnings season with its solid results. You're looking at gains of just about 16%. Let's break it all down. Free People and Anthropologie, those two brands were the real outperformers. Comp sales at Free People surging 17%. Anthropologie sales were up 13%, and that was enough to offset the weakness at its namesake brand. A number of analysts taking action on the stock this morning. The team at Barclays, which is led by Adrienne Yee, upgraded Urban to overweight, raised its price target there at $38. She highlighted accelerating sales trends in full price items. And she also thinks that it's among, quote, the best positioned in a slowing macro consumer backdrop. Citi called out, quote, the strength of the higher income consumer, saying that Urban's results were a, quote, rare bright spot during an otherwise challenging retail environment. And Jefferies was also encouraged by this report, saying that the retailer's benefiting from demand for dressy and going out attire, a trend that we have been talking about now for quite some time. Well, that message of the strong momentum and the positive trends, it was reinforced by executives on a call with analysts yesterday. Here's what CEO Richard Hayne had to say.
We currently see no signs of change in customer behavior. No indication that customers are shopping less frequently, buying fewer items, or trading down.
Certainly something that shareholders wanted to hear. To sum it all up, Rochelle, the big takeaway from this report is that while many, probably most, retailers are warning about the cautious consumer this quarter, Urban doesn't see any signs of it, at least for now.
That's really interesting because we've been talking a lot about people trading down at different stores, but not the case here. Also want to talk about inventory because that was something a lot of retailers and investors were concerned about going into this earnings season.
Yeah, inventory, Rochelle, has certainly been a theme, and that was also another bright spot in this report from Urban Outfitters. Inventory levels there down about 6% from what they were a year ago. And this is a trend that we have actually seen from a number of retailers. Taking a look back at some of the big box retailers' results that we got last week, Target reported that their inventory levels were down 16% on a year-over-year basis. Walmart's U.S. business, their inventory levels were off just about 9%. So certainly a massive reversal from what we were looking at just about a year ago when those inventory levels were over $700 billion. Retailers were sitting on $700 billion worth of merchandise that consumers simply did not want. So yes, a number of these retailers being forced to mark down items in order to clear some of that shelf space. But at least right now, it seems like retailers are much better positioned when it comes to their products and what consumers are willing and want to buy at this point.
And certainly Urban Outfitters is a great recipient of that. Great stuff. Thank you so much. Yahoo Finance's Shauna Smith. Well, under the weight of inflation, Americans are turning to side hustles to help make ends meet. A new report out from Bankrate reveals nearly 2 in 5 U.S. adults have a side hustle, with younger generations more likely to seek out another source of income. On average, side hustlers bring in $810 per month, and many use that second source of income just to stay afloat financially. Ted Rossman, Bankrate senior industry analyst, joins me now to dive deeper into the state of the side hustle. Good to see you, Ted. I mean, this is interesting because when we first thought of side hustles, it was sort of something temporary, sort of to get you through a rough patch or to perhaps help you with a savings goal. But now you're looking at 44% of those with a side hustle believe that they're always going to need one. What changed?
I think this really shows some underlying weakness in the job market because on the face of it, the job market's really strong. The unemployment rate is the lowest in more than 50 years. The problem, though, of course, is inflation. And a lot of people are finding that just one income stream is not enough. And the most common use of this side hustle money is just to get by, which I think is kind of a sad reality. It's admirable that people are putting in the extra time and effort, but they're not really getting ahead. I also think there may be some element of full-time gig workers or full-time freelancers, people who are cobbling together different income streams. Some of that may not be captured entirely by the traditional job metrics.
So to that point then, how much does this complicate when you factor in some of these that are full-time side hustles versus, a side plus your full-time, when you're trying to really figure out how healthy the labor market actually is?
I think it really showcases inequality and this K-shaped economy, that there are major differences in terms of how different groups are experiencing things. Certainly lower income households have been hit harder by inflation because they have less money to go around and their budget was mostly necessities to begin with. Lower and middle income brackets have mostly or entirely spent that extra savings that they accumulated during the pandemic. Women are another group that stand out. We know, unfortunately, about the gender pay gap. That actually extends to side hustles as well, by the way. The average male side hustler is bringing in about $1,000 a month, whereas it's about $600 for women. And then finally, Gen Xers are another group that stand out in our research as feeling especially strained these days. I think a lot of that has to do with being the sandwich generation and being squeezed between older parents, supporting their own kids at the same time, maybe starting to see the finish line with respect to retirement and feeling like they're not fully prepared. So that's another group that seems to be experiencing some strain, unfortunately.
And so then when we look at the most popular side hustles, we know that when people think of side hustles, you think, your Ubers, your Lyft, you're thinking rideshare, you're thinking delivery services, Amazon drivers. You also have Airbnb, virtual assistants, and of course, the classic that a lot of us started on, babysitting as well. Which ones are the most lucrative in this sort of environment?
It's actually remarkably fragmented. When we've asked about this, we found that very few side hustles crack double digits, and there really is no clear majority. I think it goes to show that people are creative, they have lots of different interests and income streams. A few that bubbled to the top. For women, it tended to be childcare and crafts. For men, it was more along the lines of landscaping and home repair and things like that. But really across the board, a lot of different things. A lot of people are being creative. I would like to see more people doing a side hustle that's a passion project. We found only about 1 in 5 are doing that. I think that could be a great way to keep your hand in something that you're interested in, but it's not your main income stream, but maybe it could become that down the road. But actually, what we really found was that most people are doing this because they have to, and the money is going to day-to-day expenses.
And you noted that while people are working harder, they're not necessarily getting ahead. And you mentioned the divide between men and women in terms of how much they're getting, but also there's also data in there talking about how they're spending it. Men putting more of that into savings, whereas for women, they're putting that more into sort of the cost of living as well. Why do you think we're seeing that bifurcation?
I think that showcases the gender pay gap as well. And women need this extra money more often just to get by. That was a trend that we did see across the board, too, across a number of demographic groups. It really surprises me because on the face of it, the job market's been really strong. The unemployment rate is the lowest in more than a half century, and wage growth has been pretty good. But inflation has been higher in many respects. And I think that's really a key theme here. I would love to see people side hustling to get ahead and paying down debt, especially high interest credit card debt, or saving more, investing more, having extra money for vacations and fun things. But really what we found is that people need the extra money just to make ends meet. And I think that really is kind of an unheralded story, I think, because on the face of it, the job market's very strong. I actually worry what could happen moving forward, that if this is the situation with an unemployment rate of 3.4%, what if that goes to 4.5 or 5.5? I mean, it wouldn't take a giant crisis. I'm not talking about 10+%. I think even at these current levels, a lot of people feel like one income stream is just not enough.
Well, we hope that doesn't become the new normal indeed. Thank you for breaking all that down for us, Ted Rossman, Bankrate Senior Industry Analyst, for joining me this morning. All right, coming up, a modern twist on a timeless classic. The new dating app putting an AI spin on matchmaking hopes to revolutionize the way you find love. That's next. Now for a quick check of what's happening in the markets. From the floor of the New York Stock Exchange, we have Yahoo Finance contributor Remy Blair there for us. Hey, Remy.
Well, we are seeing Wall Street trade lower on this Wednesday, but in terms of market-moving stocks, Citigroup is also trending lower. Now, Citi announced plans to scrap the sale of its Mexican retail bank, and on the heels of this news, shares did trade lower. Citi will pursue an IPO of its Banamex unit instead and spin off its Mexican consumer bank. Citi does expect this process to extend into 2025. We've been getting earnings results out from retailers, but let's take a look at what's happening in the pet care space. Petco shares tumbled this morning, and this comes on the heels of the company issuing softer than expected guidance. Shares of Petco fell by as much as 20% today, and this does come as first quarter results did beat in terms of its top and bottom line, but its guidance for the year came in softer than expected, and the company's CEO said this is because of macroeconomic trends. And to give you further insight, we saw that pet food demand was stronger in the latest quarter, and this did come even as prices were higher at its stores. There's also a notable decline in sales of supplies as well as companion animals at its stores, and services at its vet clinics increased in the latest quarter. And last but not least, let's take a look at Abercrombie & Fitch. Shares of the retailer are rallying this morning, and this does come on the heels of its earnings beat. The clothing retailer posted a surprise profit for Q1 and raised its guidance. Q1 revenue did see gains, and the company reported that inventory levels were down, and this did come on the heels of an improvement in terms of its supply chain. Same-store sales rose in the latest quarter versus an expectation for a decline. Now, as we look ahead to the rest of the week, including Thursday's session, we will be getting further insight into the spending habits of the American consumer. We have Best Buy, Costco, as well as Dollar Tree reporting tomorrow.
All right, we'll be on the lookout for that as well. Thank you, as always, Remy Blair there for us. Well, there are a lot of people looking for love and a lot of money to be made in helping them find it. The dating app market made $4.94 billion in 2022, with around 20 million users willing to pay for premium features. Now, Teleport is looking to streamline the process using one of the oldest tricks in the dating book, matchmaking. Now, the invite-only app harnesses the power of an AI to eliminate the endless swipe cycle for $111 a month. Teleport founder and CEO Chad Goodman joins us now with a look at what's next in dating apps. Good to see you, Chad. So obviously this is a space that's already very crowded. Talk us through what Teleport is trying to do differently here.
Pleasure to meet you, Rochelle. Teleport isn't a dating app. Teleport is a matchmaking membership for the most eligible singles in the world that is powered by AI.
And so with that in mind then, so talk about the process, because it's a selective process. You have to apply for membership, a considerable price tag, $111. And it does sort of feel like old school matchmaking meets AI. So talk us through the process here.
Of course. The best thing to know here is that the AI is entirely powered by the member themselves. They are given the tools that they need to get to know themselves better by going through Teleport's branded sessions, understanding your things like your love languages, your interests, your passions, as well as looking through other members on the platform and letting the algorithm know what you want to see more of in your ultimate match. Then every Monday at 11:11 a.m., you receive your 3 most compatible matches.
And so you're able to view 5 daily profiles that you can send messages to, 3 optimized matches a week, but you're only able to message 1. So I know that we're sort of in this era of swipe cycles with dating apps. What does sort of having this narrow field of a dating pool look like, and the data that AI is pulling from to make these matches?
First and foremost, as you mentioned, our membership is exclusive. So we are going through a rigorous process with our membership committee to onboard the most eligible singles in the world. And first and foremost, you're meeting people who are like-minded, who are looking for the same thing, and most importantly, are highly intentional about how they live their life and what they're looking for in a partner. So every day you go through your 5 profiles that we give you that you can use to program your AI. It gets to know more and more about you, and every day you get closer to the best representation of what your ultimate match will be.
Now, obviously, the big names in this space, I mean, you have Match.com, you have Bumble, you have Grindr as well, and you have all these companies really trying to pull in AI as well and optimize their services. Are you concerned at all that some of these bigger brands might sort of have their own sort of improved AI matchmaking service and perhaps some of this more concierge service that Teleport offers?
I'm not concerned. I've been in the industry for a while, about 7-8 years now, building my dating products, and I've personally facilitated over 300,000 first dates. But through that process, I learned the hard way that the industry is actually designed to keep you single. The business models that created the industry, Match.com, Bumble, you name it, they profit off of your attention, not your intention. They need you to constantly swipe. And they are in the business of keeping you hooked, not in the business of finding you love. So we completely rewrote the business model. It's the reason why our monthly membership is a little bit more expensive. And it's also the reason why we do not have a free version of the product. All members are paying for a service that is crystal clear what you should be getting in return.
So if you can't afford the service and you're looking for love, and you sort of hop onto Teleport's website, what should people think then?
In the upcoming years, we will be opening up the product to a wider demographic. Today, we're entirely focused on building the technology that is mandatory to evolve the human race to making it effortless to find your perfect match. And over the course of the next 2, 3, 4 years, we will have built the product and the algorithm that can predict who you are looking for and who you have the top chemistry with a high success rate. That's when we'll open the app to a wider demographic.
Fascinating stuff. We'll definitely be tracking the progress there. A big thank you to Teleport founder and CEO Chad Goodman. Thanks so much.
Thank you.
You're welcome. All right, coming up, putting the metaverse to work. How surgeons are preparing for real-world scenarios within the safety of virtual reality. And it has nothing to do with a company called Meta. Meta's Reality Labs division cost the social media company almost $4 billion in the first quarter alone, weighing heavily on profits amid Meta's so-called year of efficiency. Meta now aiming to drum up support by pitching the metaverse as a haven for job training and education. Now that's familiar territory for HTC. Their Vive headsets have been put to use by surgeons and firefighters, allowing high-stakes training in the safety of a virtual world. My colleagues Julie Hyman and Diane King-Hall caught up with Dan O'Brien, HTC America's president and global head of enterprise, a little earlier. Take a listen.
And I think, metaverse in general has been kind of really grandiose and everybody thinks it's this new thing that has to happen right away. It is down the road. It is something that actually will evolve into, but right now there's a lot of real world applications, professional use cases, whether it's in the public sector, healthcare. We are seeing, architecture, engineering, construction, great efficiencies, training and simulation, designing new products. This is across the board. Like, these are real applications being used today. We all have a version of the metaverse, but we have something we call the Viveverse. But this is for businesses. This is for corporate use. This is for benefiting your company. This down the road, this avatar and all of us kind of interacting with each other, that's things that are going to happen down the road. And there's a bunch of hurdles that we actually have to solve to get there before that can become a reality.
So I have two questions for you now then. So first, the hurdles, like I imagine some of those are legal hurdles. And then, but actually before you get to that, you made a comment to us before we got to you live with this about immersive products like the VR headsets replacing this and being just as in daily, as ubiquitous, that's the word I was looking for, as the smartphone.
Right.
How can you say that?
Well, we made a huge leap this past year in building what we call the XR Elite, which is something that's on the realm of just glasses. These products, we will introduce radios into them just like that is in your smartphone. We have a long history of making smartphones in what we call radiated endpoints or terminal points, which is a smartphone. These products will become connected. That needs a Verizon Wireless, an AT&T Wireless, a T-Mobile, a Vodafone. Like you will see 5G networks and eventually 6G networks in 2030. Where you will actually have connected wearables, and then you'll see headsets that actually have multifunctionality of mixed reality, where we can see the real world as well as digital overlays and digital introductions. And then things become much more ubiquitous and easy to use. But you actually have to deliver content to all of these wearables wherever you are. That's a huge hurdle to solve.
So part of that is the technology then and getting to that 6G or what have you. What about the human element? Because we've seen some of these products come out before. What was it? The Google Specs, right? Snap had the spectacles, I believe they were called. And like
they were just trendy.
People got made fun of. There was that, there's that sort of aspect of sort of cultural adoption that sometimes can be a big hurdle.
That's right.
To solve.
So that's why we start with, our company actually stands for innovation, technology, and humanity. So all the solutions that we've been focused on since 2015, 2016 has been solutions that actually bring value, whether it's cost savings into your corporate environment, efficiencies of collaboration in designing new products, or training nurses, doctors. We fund actual developers that create solutions to train surgeons.
So in other words, down the road, it has to be worth it for me on a consumer level to wear these things. It has to bring me something that my phone.
And on the consumer level, you really don't see anything outside of gaming right now, which is a smaller audience.
I was going to ask that because what is the use case besides just
gaming and entertainment?
Yes, exactly.
Right. So what some companies can fall into that are kind of thinking, I guess, with an infinite mindset is if they're just thinking about the short-term play and just trying to get a number of users to just play a game or play something like that, they're really not playing the long game. The long game is actually bringing the headsets and the technology into lighter, more wearable, easier ergonomics, connected to a network, and then actually changing out the use cases. Once you can actually start interacting with phone calls, once you can start interacting with content that's actually valuable to you from a consumer level, you'll see that broader adoption. But right now, we're still in early adopters and enterprise use cases.
And what's the expectation for what the market value will bear out in terms of the overall market value globally? Because, for instance, this week, China announced a state-backed metaverse platform. What's the expectation for, say, within the next 5 years?
Sure. I mean, looking at like Citi's evaluation, they expected it to be a $13 trillion, economy and business. And I think that shows one significant opportunity to actually grow into the different use cases. But I do think that overall, we will see a very, very aggressive growth. Over the next 2 years, we'll see really great adoption across financial services, banking with the use of this technology inside of their corporate environments, whether it's training, simulation, hard skills training, soft skills training, collaboration. And then I think what you'll see is kind of very similar to smartphones.
I don't know.
How that was, how we brought that into our lives, and then how we brought that into our consumer lives. You're going to see a very similar trend with immersive technology and products.
Just really quickly, there's immersive technology, there's AR, VR, and then there's the metaverse. And I think the fact that we still don't really understand what the heck the metaverse is part of the issue here.
Sure.
What is the difference? How should we even think about it? Is the metaverse really a thing, or is it just immersive technology?
One, it's today the metaverse is the internet, right? It's what we interact with from a digital standpoint. Without going too far into what the future scape of trying to understand it is, today the metaverse is an intranet use case inside of a corporate environment where you can use it for these 20 training simulations. Now, that will then be able to be connected to your regular internet. And then you'll be able to actually have brands and things of that nature get involved into, consumer products and consumer adoption.
So it becomes a metaverse when it's bigger, basically.
Yes. Right now, it's small pockets of interactive experiences. And today we do that with automotive, aerospace, healthcare. In these specific segments, we bring strong value and efficiency into these companies. And then we look at this broader thing down the road. But we will actually see, the inclusion of, the Verizon wirelesses of the world and the AT&T wirelesses of the world to actually then bring that fruition to the forefront.
That was Dan O'Brien, HTC America's president and global head of enterprise, speaking with our very own Julie Hyman and Diane King Hall a little earlier. All right, coming up, a different battle may be on the horizon for streaming giants. Our own Ali Canal has those details next. Welcome back to Yahoo Finance Live. Let's get to Julie Hyman at the Wi-Fi Interactive. Hey, Julie.
Hey, Rochelle. Well, let's look at the sectors in the S&P 500 because we are seeing this downdraft in markets here today. Interestingly, it's real estate and financials that are doing the worst today. We have talked to some guests and strategists over the past week or so who have said if we start to see debt ceiling reaction, it might in the equity market, that is, it might start to be in the banks. And so maybe that explains what's going on with the financials here, as we are not really seeing any progress ahead of that so-called X date on June 1st, when the Treasury will no longer be able to pay some of its obligations. Real estate stocks also down. That's even though if you look at rates today, if you look at the Treasury market, we're not seeing a huge gap up in those numbers. And these are some of the interest rate sensitive groups, but interesting there that we are seeing this kind of action in the markets. Let's also take a look at the banks a little bit more granularly. And when it comes to large banks, everything's red here, as you see on the screen. We also had a Citi announcing the spinoff of its Bananamex division. It's down about 3%, but really all the banks are in the red. If you go on over to the regional banks, you've got a lot of red on the screen here as well, even though this group has been rebounding as of late. If you look at the 5-day chart, you got a lot more green on your screen there, that these stocks have been doing a little bit better. Let's look at 1 month as well. There it looks more mixed, but we've been seeing a rebound in many of the regional banks more recently. So it's interesting to see them down once again today. Let's also take a look at the sort of leading indicators, if you will, of the market here today. You've got the SOX down about 2.4%. That catches my eye. We're waiting for those NVIDIA results after the close of trading today, and that has been one of the large cap stocks that is under pressure today. You see it right in the middle of your screen. NVIDIA down about 2% ahead of its numbers after the bell, but it's still near a record high and has doubled year to date, Rochelle.
Certainly important context there as we wait to hear what we hear on that earnings call coming up later on today. Thanks so much, Julie Hyman, there for us. Well, the streaming wars wage on, but the battle may be evolving. With advertising taking center stage, could we see new growth strategies emerging? Yahoo Finance reporter Alexandra Canal is here with more. Ali, what are you seeing?
Hi, Rochelle. And we are in a critical moment of the streaming wars. That's why you're seeing a lot of new revenue initiatives like ad-supported tiers, like Netflix's crackdown on password sharing, which just hit the U.S. yesterday, along with a lot of restructuring efforts as all of these companies really are racing towards profitability. So I wanted to figure out, what is the next big growth engine in the streaming wars? Is it gaming? Is it repurposed theaters? What's ultimately going to win these battles? And through my conversation, it's clear that this war is evolving. It's different than what we've had in the past. I spoke with Mark Boydman. He's a global head of media at Solomon Partners, and he told me that right now the streaming wars is not each service against each other, but these services collectively against traditional media, that old school media that we've been so used to. In his view, we will not have cable in the next 10 years, and that leaves a lot of those audiences, in addition to a lot of those ad dollars, on the table. The paid TV ad market, it's a $60 billion plus opportunity. So the big question is, which of these streaming giants can collect as much as they can from that $60 billion bucket? And that's really what's going to create the value for shareholders and increase that stock price. So, we're seeing right now this big gap between paid the advertising tier for a lot of these streaming companies and the premium streaming tier. And that's because they want to drive those subscribers to ad-supported. The more subscribers they get there, the better the impressions will be, and that's obviously attracted to ad buyers. Another big theme to watch is bundling. That's all connected to this story. That's why we're seeing HBO combo with Discovery content. We have Disney Plus and Hulu being offered together as one service. Paramount and Showtime, that creates a better viewing experience for subscribers, but also a more attractive play for these advertising giants. So that's the big thing to watch now. Advertising, really the next big growth opportunity here, as all of these players are really fighting for survival and relevancy. And I do think it sets us up for more M&A, media M&A in particular, coming in 2024.
It's true. I'm going to have to go back and try and figure out all the best bundles so I can get the most bang for my buck. And of course, a day that a lot of people in the US were dreading, Netflix announcing that it's finally rolling out its password crackdown plan in the US. Tell us more about that.
Yeah, and there's a lot of complaining among Netflix users. Now, it's important to define what Netflix says is a household. It's all those people that live within the household. So if you have a roommate, that's fine. You guys can share an account. But if you have a child that has moved out, that's a no-no. That child then has to go and create their own account. Now, Netflix says if you want to add one extra user, you can for an additional $8 a month. But that's getting pretty close to the pricing of that premium tier. So they're really encouraging these subscribers to sign up for accounts on their own. They also launched different types of initiatives, such as easier ways to manage your device. So with one click, you can sign out of all of your accounts. So if you're on the go, if you're at a hotel and you sign in there, you can easily sign out. Also, you can transfer a profile so that users that currently have a Netflix account attached to a primary household, they don't lose that data. So, you know, like I said, users aren't necessarily happy about this, but analysts are. They really do think that this is going to drive more subscribers and add to those profitability efforts. So it's something to watch, but shares today, they're up about 2%. So far, so good for Wall Street.
I mean, it seemed to work out when they rolled it out in Canada, so we'll see what happens with the US as well. Ali Kanal, thank you so much for that update. All right, time now for our chart of the day. European luxury goods have been trading at a premium, more than twice as expensive as the broader European markets. But fears of a slowdown in demand have taken a chunk out of the market in the last few days, erasing more than $30 billion from the sector on Tuesday after news that China is bracing for another COVID wave. With US consumers also facing macroeconomic headwinds, European luxury companies could see a drop in two of their largest markets. We'll be keeping an eye on that. Well, let's give you a final check of the markets right now. Still in negative territory, as we can see across the board here. That selling action still picking up, but in that trading in that narrow range. The Dow there off more than about 260 points there. S&P also being dragged down 0.8%. Tech-heavy Nasdaq, they're also down 0.9%. Big tech, especially FANG stocks, weighing on the Nasdaq, especially Amazon is the only one lifting it into the green. Nvidia also down as they report after the bell later on today. That'll do it for now. I'm Rochelle Akufo. I'll be back with you at 11 a.m. Eastern. See you then.